call the meeting, May 26th meeting of the SIC to order. This is Stephanie Garcia Richard, Commissioner of Public Lands, sitting in to chair for the governor. I'm going to just lay down a couple of ground rules before I turn it over to Carrie for roll call. That is that every vote is going to be a roll call vote today, as per the guidance of OMA by the Attorney General's office. I'd like to just remind folks to mute themselves when they're not speaking. Introduce yourself when you are speaking, so we can keep a clear picture, keep everyone straight on who's speaking. Please reference the diligent materials and page numbers as you're speaking. And I will try to be as cognizant as I can of member questions, making sure members are able to participate and contribute as they'd like to. So just kind of, if I've gone over you and moved on to the next agenda item, just please interrupt if you've got comments or questions. So with that, I'll turn it over to Carrie for a roll call.
Just a moment, please. Commissioner Garcia Richard.
I'm here.
Treasurer Eichenberg.
Present.
Linda Eitzen.
Present.
Tim Jennings. Harold Lavender.
Carrie, this is Steve. We're getting feedback. If Dave or Consuelo could check on that, please.
Okay. Harold, I know I heard you earlier. Lee Rawson.
Present.
Michael Messina.
Present.
Nicholas Tejas.
Present.
And Debbie Romero. Peter Frank. You do have a quorum, Commissioner. And then would you like me to do the staff attendance?
Staff and advisors, please.
Okay. Steve Moise.
I'm here.
Vince Smith.
Good morning, all. I'm here.
Evan Land.
Good morning.
Brent Ship.
Good morning, I'm here.
Charlie Woolman. David Lee.
I'm here.
Paul Chapman.
Here.
Starla Bennett.
Here.
Chris Cassidy.
Here.
Clay Camper.
Here.
Clayton Cleek.
Present.
Mikhail Kuznetsov.
Present.
Bruce Brown.
Here.
Nino Carpenito. And from RBK, Marcia Beard and Matthias Bauer.
We're here.
Thank you. Mercer, Richard Pugmire and Amy Ridge.
Yes, we're both here.
Townsend, Jack Koch and Seth Marcus.
Yep, we're both here as well.
And from Axia, Jennifer Wildman and Tim Nest.
Yes, Jennifer Wildman is on the line, but Tim Nest is not joining.
All right, thank you, Jennifer. And then from Managers Present from IPI.
Yes, hi, good morning. Matt Ahern and Tom Lynch are on.
And 1 William Street.
Hi, good morning. This is Josh Simon. David Shear will be joining me in a little bit.
All right. Then Linden Advisors.
Yes, good morning. It's Jim Delaney joining, our COO, and Joe Wong, our founding partner and COO, will also join.
Thank you. And is there anyone on the phone from New Mountain? Okay. And is there anyone that I've missed? All right, I guess that's it, Commissioner.
Thank you, Carrie. So can you just remind me, who are the council members that are on right now?
Everyone, I'm not sure if Peter Frank has joined yet. Peter, have you joined us?
This is Harold. He just texted me. This is Harold. He just texted me that he didn't have in just a moment. Peter.
All right, thank you.
And Debbie is sitting in for DFA?
Well,
Is she on?
it's my understanding that Olivia has left, and Debbie Romero is now the acting secretary of DFA.
And Debbie, are you on?
Hello.
I have 6 by my count.
Hello, this is Peter Frank. I'm here. I don't know if you called me.
Hey, great. Thank you, Peter. Okay, so we're back then.
You should have 9 on the phone, Commissioner. The only ones absent are the governor and Ms. Romero.
Okay. All right, great, thank you. So we're going to move on to agenda item 1B, approval of agenda. Do I have a motion?
This is Linda Eidson. I move for approval of today's meeting agenda.
Second. Carol, second.
Okay, so we have a motion by Member Eidson and a second by Member Lavender to approve the agenda. Terry, could you call the roll?
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg. Peter Frank.
I'm here, yes.
And you approve of the agenda?
Yes, I did.
Thank you. Linda Eitzen.
Yes.
Tim Jennings.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Michael Messina.
Yes.
Nicholas Tejas.
Yes.
And Treasurer Eichenberg, did you... I'm not sure if the treasurer is still on the line, Commissioner, but...
So that's 8 affirmative.
That's correct.
Okay. All right. So we have an approved agenda. Next, we're going to the consent agenda. Items 2.
Madam Chair, this is Lee.
Yes.
Madam Chair, this is Lee. I would ask that the new Mountain Partners be removed from the consent, and we deal with it right away, but just not on the consent.
Madam Chair, this is Linda Eidson. I would like to add a comment from the Investment Committee regarding consent items relating to re-ups. I wanted to give the criteria that the Investment Committee uses for re-ups, such as New Mountain. Perhaps this will also help Member Rawson have some comfort as that this item has been reviewed. The Investment Committee...
Madam Chair, I would only point out that I've got questions to ask, and whether or not we approve it is not the issue. The issue is if it's going to have any discussion, we need to remove it from the agenda, not whether or not I agree with the Investment Committee and what the job they've done ahead of time.
So, Member Rawson, could you let Member Eidson finish, and then we'll take your motion and see if there's a second?
I don't think it's debatable. I don't think it needs a vote.
We don't need a motion to take something off the consent agenda?
No, we've always dealt with those out of, I think that's just a matter of respect and how you do things. I mean, that was part of the issue when we came up with the consent calendar that we've only had in place for, a month or two here.
My recollection is that if a member objected, it would go off its consent agenda.
Okay. All right. So then what we'll do is have Member Eidson finish her comments, and then we'll take it off and act on it.
Okay, Madam Chair, this is Linda Eidson again. I want to advise the members of the SIC that when we first discussed the re-ups as being consent agenda items, the Investment Committee said that they would review each re-up as if it were a new investment. So it goes to the Investment Committee exactly as if it was a new investment, and we review it as if it were a new investment. I am going to give the following 9 items, which which are criteria that it must meet as a re-up before we on the investment committee would approve it as an item in a consent agenda. Number one, it's the same fund manager. Number two, it's the same portfolio management team. Number three, it's the same strategy. Number four, it's the same investment process. Number five, it still meets SIC asset allocation strategy and pacing schedule. Number six, the performance of prior funds met expectations and are in top quintile. Number seven, the fees and terms are the same or better than the prior fund. Number eight, it was compared against other choices and it is still the best in class. And the last, investing a similar amount as in the prior fund. So these are the criteria that the investment committee uses as we review any re-up company. And again, we have reviewed that re-up fund as if it were a new fund at the investment committee level. So I just wanted to let the members of the SIC know that this has not just been a rubber stamp, oh yeah, it's a re-up, next item. Thank you.
Thank you, Member Eisen. So, Member Lawson, you would like this to be removed from the consent agenda and acted on separately?
Correct.
Okay, I'm going to just ask that in future if you could do that when we're approving the agenda as an amendment to the agenda. That would be appreciated. So we'll just take this action item right now. Is David ready to give a presentation?
Yes, Madam Chair. Thank you.
Thank you.
This is David Lee, Private Equity Director. I am joined on the call, in case you didn't memorize the roll call, by Chris Cassidy, the other 50% of the private equity staff. Also,
Madam Chair,
I have a point of order.
All right, I'll take the point of order first, and then I'll go to you, Member Lawson. Is that Member Frank?
Okay. Yes, and I think that we're going about this incorrectly. I think if Lee Rawson has questions, I think we should just go to his questions. I don't think we necessarily need a presentation unless Lee thinks that's required. I think he has questions. Let's hear what the questions are.
But that's exactly my point. I didn't think we needed to have the whole presentation. That's not the goal here. But,
Right.
If that's okay with the presenter there, I mean, I just asked a couple quick questions and move on.
Absolutely. And we have Richard Pugmire and Amy Ridge from Mercer that are also on to answer questions. And hopefully, Burris and Steve Pensky of New Mountain will also be on to answer questions.
Okay. Thank you, Madam Chair. If I can proceed, but one of the questions had to do with the management fees, and I know that it was stated that they're the same, but there's a curious provision in here I don't remember seeing on anything before, and I just need explained to me how that works, and then also how, if that was in the original investment. But on page 26 or Mercer page 4, it notes that the pro rata share of outstanding borrowings, and I didn't quite understand what that was addressing.
Sure, I can take that and
fits in.
Richard or Amy, if you want to chime in. The outstanding borrowings typically refer to a subscription line. Most of our managers at this point, in order to basically reduce the frequency of capital calls, and it also does help their IRR, when they commit to an investment, as opposed to rushing out a capital call to all of their clients, they will borrow money through a subscription line set up with a bank. It's a low-interest subscription line that's backed up by basically the LP commitments. And this is Steve Klinsky. I'm on the call now. Thanks. And this is basically just a recognition that investments are made. They're just made through a credit line as opposed to the call. The call comes later, and it comes them calling capital. So whether they call the capital from you or whether they use the credit line, it's still considered invested capital into the company, and so that clarifies the definition of what is invested capital and what the 1% management fee is based on.
Okay, great. That's very helpful. Second question on page 58 or Mercer 36. It's talking about the ESG clauses, and I was trying to understand what the anti-corruption, it says, let me get down to it, the anti-competitive behavior. And I was trying to get my arms around what anti-competitive behavior would be that would be of concern.
I guess we have Steve Klinsky on the line. Maybe he could take that. Steve, this is in the ESG metrics that you use. One of the metrics is anti-competitive behavior and governance.
Well, I think what you're referring to is, along with just having a good social dashboard of job creation and no bankruptcies and all that sort of a general good citizenship, every time we buy a company, we choose 3 metrics off of a list of 24 different metrics and specifically have the team work to improve those metrics for the company. So I believe that may be one of the 24 metrics, but we choose three different ones for every company and work to improve those the same way we work to improve earnings. And frankly, I don't remember anti-competitive behavior, being one of the key metrics that we've ever actually used, but it's probably on that list of 24.
Well, I was trying to understand what it meant, Steve, because I guess in my mind is we're trying to get the best return we can as investors and as a company, and part of that would be, you want to have the least number of competitors will help you increase your margins. So I was trying to figure out, well, I understand corruption. I don't understand, anti-competitive behavior, what would that be? I mean, yeah, if you're running a race and you push somebody over, that might, but I don't understand how it fits into what we're doing.
Yeah, frankly, I go back and look at the list. It's not one. If it's on the list, which I presume it is, because you're quoting it, it probably has to do with not, committing antitrust violations and not breaking the law. And if the company that we bought had been violating those laws, we would obviously straighten our governance and clean them up. But it has not been a front center metric that I remember ever actually being one that we've, focused on. We focused on other things. If a company want to make sure they have good environmental quality and all that sort of thing, but anti-competitive behavior, I don't remember actually ever coming up as an actual circumstance, but it obviously seems to be on that starting list.
All right, thank you. Finally, Madam Chair, maybe just a comment that, this particular investment it represents 161 pages of the package. 30 pages of the packet, 30% of the packet is committed to an item that's on a consent calendar. And this particular second go-around is 20% higher than our initial investment. And I guess that's part of what concerns me is having the investment equal to or lower, but once we go on higher, then I just question whether it should be under consent. But those are my concerns, and I appreciate your indulgence.
Thank you, Member Rawson, for your observations, and I'm wondering if there's any other committee members that would like to weigh in now before I take a motion on this item.
Thank you, Madam Chair. This is Tim, and I would like to.
Mr. Treasurer.
Thank you. I appreciate, I apologize to all of you. I lost voice. I could hear you, but you couldn't hear me. But I was going to do the same thing, which was take this off of the consent agenda, because I think that the risk is rather high, and I think that the fees are a little much, and so I wasn't in favor of it. And with a 46% increase compared to their NMP5, I just thought that was kind of extreme. So I appreciate the opportunity to voice my opinion, and thank you, Madam Chair.
I'm wondering if any of the staff would like to comment comment, or can we move on to motion?
This is David. The terms, I believe, are similar to Fund 5. Fund 6 is bigger, and it is expected to have a target of 25 to 30 companies, which is a little bit more than Fund 5. I believe that there are more opportunities that they see in the particular sector niches that they target, hence the reason for the increased fund size. Typically what staff and consultants focus on when we see larger funds, which almost always happens when it comes to successful funds, is an increase in staff, kind of commensurate. And we have seen New Mountain, as an organization, continue to add resources. They have a large investment team, and they've increased it materially, for instance, since the end of 2014 and 2016. So that gave us the comfort.
And this is Richard from Mercer. And the other thing is looking at strategy drift when you look at fund size. And New Mountain has been very consistent at targeting companies of similar size throughout its history, despite its growth. Fund size growth is something we have to deal with in the industry because successful funds do tend to grow their fund size. So, as David said, we look at the capacity. We look at are they growing their team commensurate with the fund size growth, and also look at the strategy, which we're comfortable with in that.
Thank you all. So with that, we'll take a motion on agenda item 2B.
This is Linda Eidson. I move for approval of New Mountain Partners 6 LP pursuant to the discussion in the materials presented today.
This is Harold Lavender, second.
Okay, I have a motion and a second for agenda item 2B. If I could have Carrie call the roll.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
No.
Peter Frank.
Yes.
Linda Eitzen.
Yes.
Harold Lavender. Lee Rawson.
No.
Tim Jennings.
No.
Mike Messina.
Yes.
Nicholas Tejas.
Yes.
Harold, I didn't hear your vote. Harold Lavender.
I'm a yes.
Thank you.
I'm a yes.
The motion passes 6-3.
Okay, thank you. With that, we're going to move to the consent agenda, and what we have left is the approval of SIC minutes. Can I have a motion on the consent agenda?
This is Tim. I'll move approval.
Second, this is Linda.
Harold, second.
Okay, we have approval by Member Eichenberg and a second by Member Eitzen for approval of the consent agenda. Carrie, if you would take the roll.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Linda Eitzen.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Nicholas Tejas.
Yes.
You have unanimous approval.
Great, thank you very much. We're going to move on to agenda item 3, and we'll start with the SIO report.
Thank you, Commissioner, and good morning to all of you. The current net asset value of the funds which we have under management, $26,581,000,000. And let's look at distribution May of 2019, that 12-month number went from 824 to 887 million. And in May of 2020, the funds distributed over the past 12 months $1,006 million. So the distribution growth, as we emphasize consistently, is what the funds are all about. I shouldn't say that it's everything we're about, but it is certainly a major portion of what is important in connection with endowment funds. West Texas Intermediate Oil, as of this morning, was priced at $34.22 per barrel. Under the portion of my report referred to as investment matters.
When participants join and leave your conference, you will hear tones. For name announce, press 1. For tones, press 2. For silence, press 3. And when participants join it, you will now be placed into conference.
$100 million to the fund. And as of yesterday, we received this report from Sun Mountain Capital, the organization that is administering the fund on behalf of the council. 90 applications had been received. Those that had made their way through their investment committee and had headed to phase 2 of due diligence, having been invited to submit applications for funding, 43 of the 90. Those who submitted applications for funding, 23 of those 43. 6 term sheets had been issued. 3 of those had been accepted. 1 applicant had completed the final due diligence and had legal documentation pending. There were no loans funded as of yesterday. However, Sun Mountain expects to close 1 loan this month before the end of this week and other loans in June. The size of their current pipeline, and these are rough estimates, I think will be interesting to you. In process, in their pipeline, about $60 million worth of loan applications. And those that are projected to likely close, 35 million of that 60 million. Sun Mountain reports that they are moving quickly on additional loan applications. They have made an initial capital call from us, and we have funded that. And they expect to make another capital call next week. They say that they're beginning to hear more significant new applicant interest, and they expect what they call the top of the funnel to begin growing again as the PPP funds are depleted. The SIC staff is very closely engaged with Sun Mountain and is monitoring their progress. The next item on the agenda is performance under B4 of my report, and I will defer that item to Vince and RVK a bit later on our agenda. And then moving quickly to item E, external relations. Under legislative matters, as all of you know, we continue to work on House Memorial 9. Bruce Brown and Charlie Woolman have had a conversation with the state land office as they are involved and engaged in this undertaking. We are waiting for the results of the RETA study, the Renewable
members? Hearing none, we'll go on to the CIO report. Vince?
Thank you, Madam Chair, and good morning, everyone. I'll be relatively brief here. We are seeing a very strong stock market rally since the market bottomed in about the middle of March. Really in the face of still a lot of uncertainty on the economy and how we're going to come out of the lockdowns and how we're going to get the economy restarted. But a good bit of optimism, it looks like, from market participants for risk assets. So we're seeing stocks climb. We're seeing credit spreads come in just a little bit from the wides that they were trading at some time ago. And a lot of the sectors of the market that ran into liquidity problems have recovered quite a bit. So we're seeing a general, righting of the ship anyway in terms of risk assets, and a great deal of optimism on what looks like is coming forward. We're probably a little more pessimistic about, or at least a little bit uncertain about this market rally. We think once some of the realities of the economic hit that was taken start coming through, people will rethink their positions a little bit, and we'll see a little downdraft in the stock market. But that's yet to be seen. There's a good bit of optimism out there right now, and we're taking it day by day anyway. Performance for March and April, a preliminary for April, are in your books. In March, we were down about 9.7% on the land grant permanent fund. That was a very good performance relative to peers, but we did lose some against the benchmark. We investigated that, and when you look at your April report, you'll see that we bounced back quite a bit in April. So a lot of the underperformance that we saw in the March quarter had to do with some of the sectors of the portfolio where liquidity constraints or liquidity concerns came in those markets and drew some valuations down. Those snapped back sharply in April, and they continue to do so in May. So it looks like we're bouncing back above the benchmark, hopefully for May. So all around a good performance on both relatives, if you include the April bounce back against the indices. Going forward, we've entered a recession. We talked about that a little bit the last time. So we've entered the recession phase of the economic cycle. The next phase, of course, is early cycle. So we'll bottom out on economic growth at some point and start rebuilding from there. Markets usually move forward in advance of that actual bottoming. We'll see a very strong downdraft in GDP growth for the June quarter, probably on the order of 30 or 35% annualized. The biggest recession we've probably ever had in terms of its one quarter depth. We should see a bounce back in the third quarter as people get back to work and the economy starts to right a little bit. But we do expect for the year 2020 to have a negative sign in front of GDP growth, and for GDP to start moving back ahead in 2021. So we would look for markets, at the bottom ahead of that, maybe later this summer or into the fall, and then take off
10-year period. It is very interesting to note that land grant has a 7% target, and the 10-year is at 6.86. Severance tax has a 6.75% target, and they have an actual 10-year performance of 6.43. What's really important is, especially with so many new members on the SIC that have not been through the every 3-year asset allocation study, is that we set these targets, but we think are realistic for a long term, meaning we're looking at 7 to 10 years, and we are looking at intergenerational equity. So we're trying to see how to keep this fund alive for current and future generations, given the market that we're dealing with and the risk tolerance that the SIC has given to the State Investment Office. And that's how we established that 7% target for land grant and the 6.75% for severance tax. And as we participate in this 3-year study that's going to be coming up this summer and early fall, it will be real interesting for those who have not participated in it before to see how we arrive at those targets and why those targets. And here we're seeing that the 10-year average is actually a little bit below the targets that we have placed on those long-term performance. And I just wanted to mainly point that out because with this study coming up, this is a very crucial criteria for how we look at these funds, how we do the asset allocation, what investments we picked, and what our goals are. So this is a very important graph and will be all the more important as we look at the 3-year asset allocation study.
Thank you, Member Eisen. Any other questions for Vince before we move on to RVK and the monthly performance report? All right, Vince.
Let me pass over to Marcia and Matthias. Hey, good morning, everyone, and thanks, Vince. Appreciate the great lead-in. I'll maybe start with the executive summary. We'll take a look at that, dated March 31, starting on page 197. We'll review that before looking at the April flash report. But maybe just before we look into the specific performance, we'll make a couple comments as it relates to the performance this year so far, what's been driving the market, hopefully to provide a little bit of perspective on those numbers. As we've talked about in the past, we've had one of the most aggressive and rapid equity sell-offs in history during February and most of March, and then April saw sort of an extreme reversal of that with one of the most substantial market recoveries that we have on record. So interesting time in the market to be sure, and I think we still have a lot of uncertainty ahead of us. Global equities, they were up double digits, as I mentioned, very strong return in April, and built on the gains that we saw in the final stretch of March. And that recovery, which has really continued into May for the most part, has recovered about half of the losses from earlier in the year. So we still have quite a way to go, but have managed to claw a little bit back. As I mentioned, May on balance, now particularly with the most recent weeks added to that, have been generally positive, but there were some early concerns about whether reopening the economy, how to do that in phases, or what the best approach is reasonable. Some fear on second wave of infections, and those haven't gone away entirely, but I think there are a lot of positive news and momentum, mostly perhaps hopes at this point in terms of loosening restrictions and the types of developments that are coming through in terms of vaccines. So I think the folks are eager for good news and are certainly trading around that, but I think it's probably too early at this point to make any meaningful long-term conclusions until we have more factual information on hand. As we talked about, central bank liquidity continues continue to providing injections, and that's boosted those risk asset returns, equities in particular. And we've seen fiscal response that's been quite high and accommodative as well, more so than ever, really. Now there's a second $3 trillion stimulus relief bill that's been unveiled, passed by the House, and I think being discussed by the Senate in the next week or so. So we'll see where that goes. I think we'll have a lot more friction on this one than the first one. But again, there is certainly a willingness to be very, very accommodative and try to get in front of this as much as possible. Whether it's enough and how far it takes us is yet to be unseen. Some of that shows through in the unemployment data that still continues to weigh on markets, and I think it's going to keep a damper on things for some time. Total claims now somewhere in the 38 million range, so very, very high. And perhaps the only silver lining, if you can call it that, is that weekly claims have been decreasing for a number of weeks now, although, again, we're still adding a fairly substantial amount week after week, even though the rate of growth has decreased quite substantially. Interest rates are very low. They were low, and now they're even lower. On the 10-year, we're about 70 basis points, and you really have to go out to the 30-year to see anything with a 1 in front of it, or that's 3 digits. So very, very low. Not a lot of forward-looking returns there. So that's, I think, very much in line with Vince's comments in terms of what do you do, how do you invest in this type of environment across the fixed income markets. And more of that, I think, we'll hear a little bit later in today's presentation. But credit spreads, that's exactly right. Those have come in, so they blew out. That's fairly standard when you have substantial market dislocation, spreads widen. They've come in during April and continue to tighten into May. This has been helpful for some of the managers in the portfolio, but really, truly across the board that tend to have credit exposure or other what's called plus sector exposure, things that are a bit outside of just your treasuries and agencies, things that tend to have a higher prospective return. And you might recall that treasuries, so really the safe haven asset was the one that had the best return in the sell-off, and by a fairly wide margin. So any manager or any type of exposure short of treasuries really didn't protect you as well as that, and so we saw a reversal of that as those spreads have come in the last 5 or 6 weeks or so. Inflationary pressures, which hadn't been all that strong to begin with, have materially reduced in the weeks since, primarily led by the energy sector. We obviously saw some very substantial price declines in oil in particular, as there were tremendous supply and demand imbalances. Those have not corrected by much at this point, although we have seen, as Steve already pointed out, oil lift off of the Q1 lows that we saw in the teens and even lower there for a short period of time. Food prices is probably the only area that we have seen some upward pressure on inflation, but not enough to offset the material decline that we saw across the energy sector. So still very, very low. That has implications that will flow through into the capital market assumptions that we put together, and then certainly the asset allocation work that Linda alluded to that is getting geared up, and we've obviously been thinking about. But this is it's a dynamic market, and one that we want to be on top of and factor into the work, and then of course the recommendations that come forward as a result of that. Just a couple more comments on U.S. dollar strength that's been fairly resilient as well. And as we've talked about in the past, when you have fairly strong U.S. dollar performance, that tends to be a headwind for those foreign investments, both across things in the fixed income space, but primarily in the equity market, as you're essentially paying a higher exchange rate on those earnings by the time you convert them back into dollars. So a little bit of a headwind there. If the dollar strength subsides, obviously that will be a tailwind. So it can go both ways, but perhaps helpful to keep in mind when you're looking at those numbers. So I would say, again, overall, there's been some positive developments. I'm a little worried that some of those might be resting more on hope than actual fundamentals in the economy, that we're sort of through the worst of it. I think we'll have a better sense of how the second half of this year is going to shape up once this quarter's earnings, so second quarter earnings are released. I think a lot of that really didn't get captured with the Q1 numbers. But I think if we could come out of that okay, and as Vince said, GDP numbers are expected to take a pretty substantial hit, then I think we'll have a better sense of what the path forward looks like. So maybe with that, I'll see if there's any questions, and then Marsha will walk you through the specifics on the portfolio performance.
Marsha? Good morning, Madam Chair and council members. Matthias and I look forward to seeing you face to face in sometime in the future. After hearing both Vince and Matthias say things were bad, that they've improved, but we are very cautious. I'm going to take you back to March 31st because I think it's important. We did review preliminary performance at the last meeting, but we have final performance now, and there's a couple items that I think we want to review with you before we go to the April flash. So in your book on page 202, this is looking at the land grant and the severance tax versus their target allocations. Now remember, you have an interim target. You'll see an overweight to your core fixed income, and remember that is you're moving more into your non-core fixed income. The target for your non-core fixed income is 15%. You're at just over 12%, and you're going to be bringing down your core fixed income down to 10%, and you are just over 16%. So you are still moving towards your long-term target. The same could be said for severance. On page 203, we are now including allocations for tax stabilization, water trust, tobacco, and rural libraries. And just a reminder, when we look at performance in a moment, that your tax stabilization and your rural libraries are in fixed income and in real estate, so no equity exposure in those two funds. Looking at your total fund performance, again, we looked at this as a total fund, not by land grant, not by severance, when we last met in April. We're showing for the land grant the return for the quarter was a negative 9.74 on a net of fees basis, and you can see that your policy index was down only 9.07. So on an absolute basis, it was a very, very tough quarter. Relative to your benchmark, you underperformed. We talked about the reasons last month, and I'll remind you of those in a moment. You can see the same quarter performance for severance was down, net of fees 9.94, so doing worse than the land grant. That is on an absolute basis and relative to your benchmark. In a moment, we'll look at how you did relative to your peers. On the top part of that chart, we're reminding you of your investment objectives in your policy. And I just want to remind you, the portfolio can only give you what the market gives you. So you need exposure to equities, and it was a very difficult quarter for pretty much anything but treasuries, as Matthias mentioned. But on a performance basis, you have met your policy expectation for the land grant, beating the policy index. You did not for the severance tax. You trailed that by 33 basis points and a bit more on a net of fees basis. Attribution, this is for the quarter, and what's most important here is if you look at the green bar, which was your actual performance, versus the blue bar. Again, Linda referenced the importance of asset allocation. This is just a reminder that how you choose to allocate your assets is the biggest driver of return. So talking about asset allocation is, we believe,
the most important decision you can make, how to allocate amongst the asset classes. So that was the biggest driver of return. You had some on a net basis, if we compared your managers to their benchmarks, you can see it was a slight positive, slight value add against their specific benchmarks. But then if you look at the one that says SS on a takeaway, we've talked about this before. It's not a perfect, the non-core fixed income is not a perfect benchmark. And if we compare that, it was a detractor from performance. But we'll talk about that in a moment as well. Let's go to page 208. This looks at calendar date, which would be quarter performance. At the very top line is your total fund. Again, that negative 9.42 is for total. Right below it is land grant, and you can see the underlying funds as well. For example, you can see that tax stabilization and rural libraries did not lose as much in the quarter. Remember, those are more fixed income and real estate, so they did not have equity exposure. And then we now show longer-term performance for the funds that have been invested for a while. One thing we didn't talk about last month because we didn't have the information is on page 211. This is for the land grants. A lot of information on this chart. But I'll take you to the top and look. If you look at the quarter, the second column, I guess, the land grant total fund was down 9.74, and that's very hard performance for the quarter. But if you look 4 lines or 3 lines below that, and you look at the all public plans greater than $1 billion, the median return for that universe of 69 other plans, the median return was a negative 12.43. So relative to your peers, you had a very good quarter, and that's reflected not only in the quarter where you ranked 21st percentile, but if you take your finger and go across under all public funds greater than $1 billion, for the land grant total fund rank, you can see well above median returns for each annualized time period shown, top quartile in most cases. So again, relative to your peers, you lost less, and it's reflected in your longer-term ranks against your peers. We show 2 other universes. The one on the bottom is if we looked at all the public plans in the universe, so there's 683. So some of them are very small. Relative to those, you did even better. If we look at the very large plans in the net of fees universe, there's only 13. They did a little bit better. And your rank there is not quite as strong, but really the most, if you look at the numbers down below and look at median and average, you kind of fall in between that billion and 10 billion. So we believe that the greater than $1 billion, it's a larger universe, and there's a lot of your peers in that universe. If you had to look at a page in our report, I think 212 is a very good story. Each dot represented on this page is looking at your 3-year rolling rank. So looking at your 3-year look-back rank for each of these time periods. And if you start with, look down on the bottom and see September 2012, look at all the dots, and each of those, there's only one dot that fell below median in that time period. So you've made allocation changes to your portfolio that have protected you. What we wanted, this is exactly what we wanted to see. We believe that if you can stay above median, you don't have to knock the socks off and be in the 10th. Where we want to see you is consistently above median, and that gets you those long-term ranks that we just saw, 21st percentile, 24th percentile. And you've made great choices to get you there. I'm pausing to see if there's any questions. information for severance tax, as I mentioned before, it ranks not quite as strong, but if you look again for the quarter, 24th percentile, for the 5-year, 35th percentile, so above median as well. I wasn't going to go over this page on 214, but I'm just going to make a couple comments. Vince was talking about, decisions going forward. This looks at the top chart is looking at your allocation, not your target, but your allocation as of March 31st, and then comparing it. The 4 boxes is looking at that peer group of 1 billion and greater and where you fall. And this shows that you had less in U.S. equity than many of your peers. And you had designed, not only that, but you had designed your equity to hopefully capture on the upside, but to protect on the downside. You had slightly above median allocation to non-U.S. Those funds that had a home country bias did better because U.S. equities did much better. And I also want to point out that on U.S. fixed income, this is really, I'd be careful about this peer group because this includes both your core and non-core, and not all of your peers are structured the way you are. Page 215, looking at risk and return, let's look at the left hand. The top chart is the 5-year period, the bottom chart is the 10-year period. This is against that appropriate benchmark or universe of greater than $1 billion. And you can see the blue is the severance tax and the green is the land grant, your actual fund performance. The yellow and orange are your long-term policy targets that you're not at those policy targets quite yet, but everything falls in that northwest quadrant where you have above median return relative to your peers at below median risk, and that's exactly where you want to be. The same can be said for the 10-year, and your 10 years actually moved up, been brought up by your performance in the nearer term. So that is looking at total funds. So well done on the asset allocation. On page 217 is an asset class composite page, and that's a summary. I'm going to go through a few of these asset classes to make some comments, but I know we've got a lot to go over today. If you go to page 219, this is just a summary for U.S. equity. What is it? It tells you if there are any hires, any fires, if you're at your target, and you are at your target, and there was no hires and fires during the quarter. There were no significant manager events. So let's look at the equity performance. And we talked about this last month, and I know Starla is going to be coming forward with more discussions on the U.S. equity. But your U.S. equity composite for the quarter trailed its benchmark of the Russell 3000. On a net of fees basis, the U.S. equity composite was down almost down 21.74. The Russell 3000 was down 20.9. Now, what's interesting about that is definitely underperformance. But you ranked against your peers at the 50th percentile. And fiscal year to date, you also trailed significantly, but you ranked in the 41st percentile. So it's been a market environment that hasn't that has favored passive, hasn't favored active management in particular, has not favored small cap or value, and you do have a bit of a small cap bias, and also factor your fundamental, your factor based managers. The factor base was biased against large caps, and large caps outperformed. So there's some structural issues that were a headwind for you, but relative to your peers, you were a median performer, and you can see the subcomposites there. Looking at your expectations against your policy for the 5-year period, you trailed the benchmark, but you did rank above where you expect to, or your expectations. So a little bit different story. If we look at your U.S. equity composite, it falls in that correct quadrant, above median return or below median risk. This is for the 5-year period. Interesting for the quarters, out of that 20-quarter period, there were only 4 quarters, down quarters. You did just ever so slightly better on the downside, but you didn't capture all the upside there. You gave up. Gave up some of the upside, and there were far more up quarters than down quarters. And then I think it's interesting on page 222 just to look and see how the U.S. equity portfolio is positioned. You can see at the top a slight mid to small cap bias, and then you can see the sector weights down below. Non-U.S. equity on 224, some no hires or fires, but some manager announcements there, nothing that gave us pause. If you look at performance here, it's a little bit opposite of what we talked about with U.S. equity. With non-U.S. equity, you actually outperformed your benchmark during periods, but you ranked below median. So again, if you look at the 5-year period here, you can see that that 5-year period was negative, pretty flat for you, but you did better than your benchmark. And you also, for the 5-year period, I think this is a misstatement. I think that should be a no, that you actually ranked, you weren't in the top 2/3. You were at the 71st percentile in this universe for the 5-year period. So did a little better in time periods in the benchmark, but your ranks are right around median or a little bit below. You can see the risk return here. And then on page 27, looking at your regional weights is always interesting. And then you can see your capitalization versus your benchmark. On fixed income on 229, again, not quite at your long-term target here. We did have some manager news, but nothing that made us say you need to do a search. If we look at your core fixed income performance on page 230, you're in line with your policy expectations for both performance and rank. I do want to mention here, because it was a comment that we talked about last time, was if you look at your core fixed income for the quarter, you were a positive 0.7, but the benchmark was up 3.15. This was really a tale of duration was a bit of a headwind for you. You gave up some duration to have liquidity in your portfolio, and 2 of your managers in the core bucket actually have plus sectors. You have PIMCO that had very little in treasuries, and remember, as Matthias said, treasuries were the place to be. And they also had some emerging market exposure and high yield exposure, which did not do well for the quarter. And the same, even more dramatic for PGIM, that had plus sector exposure that was a headwind for them. You'll see in a moment that they gained some of that back in April. On the non-core fixed income side, this is a hard one because there is a benchmark issue, but you did have some headwinds in the structure of your portfolio for the quarter. If we look at the performance at the end of March for high yield and for bank loans, it was very difficult performance, very bad market for high yield and for bank loans, and you had exposure to that in your non-core fixed income. But it is a benchmark issue that's been discussed. Remember, we lagged that benchmark 1 month, and that had a pretty dramatic effect, and I'll show you that in April as well. Characteristics for your fixed income portfolio are shown on page 231. I'm going to not address your alternatives. Your alternatives managers will be here, but if you go to page 233, you can see the quarterly performance, how it's calculated by RBK. I think it's more meaningful to get that from your specialty consultants on the performance. If there's no questions on the quarterly report, I'm going to take you back to April quickly. to ask.
Should we hold those to the end? Any questions on the quarterly report?
This is Linda Eitz, and I just wanted to congratulate RVK on another award, as they stated on page 235. It's really good to know that we're dealing with the top-in-class consultants.
Thank you, Linda. Greatly appreciated.
Marcia, why don't you go on to the monthly report?
So I'm going to ask you to go to page 180, and this is preliminary performance for April. So there's no performance for the land grant or severance. We can only give you total fund performance, but a couple comments here. As Matthias and Vince said, April was a much better month. You were up 3.98. If you look at the land grant interim policy index, that was up 2.48, and the severance tax was up, hard for me to see, up 2.65. So on a preliminary basis, you had a good month on an absolute basis, but also relative to your benchmarks. If we go to page 181, again, at 3.98 for the month, still on a calendar year-to-date negative, and on a fiscal year-to-date negative as well. If we look at the underlying composites or the asset class composites, global equity trailed, and if you look right below that, you will see that came again from U.S. equity. Now there is the same things that hurt you before was a headwind for you in April. I will say that I believe that there was also some liquidation, so there was some cash in the portfolio that detracted when the U.S. equity market was up 13%. That was a headwind as well. If we look at non-U.S. equity, you can see outperformance, pretty even with the benchmark, but slight outperformance. On fixed income, down 0.10, that's for core and non-core together. If we look at core fixed income and compare that to the Bloomberg US Ag, you can see outperformance there. So PGIM and PIMCO did much better. If we look at your non-core underperformed core, but you look at the benchmark, you outperform that benchmark dramatically. Again, remember the benchmark is lagged 1 month. So things like the high yield and the bank loans, which hurt your performance last month, is incorporated into this benchmark performance here. It's complicated, but that lag was pretty dramatic for April. If you go to page 182, another bounce back. Certainly didn't bounce back enough, but your MLP, your financial real return, which is just your harvest MLP portfolio, was up 32%, and the rest, this is a monthly flash, so we don't have private equity or private real return or private real estate returns. I do also want to point out another bounce back, because we went through some pretty ugly numbers. On 183, if you go to the bottom, and again, if you look at longer term, Donald Smith, one of your small cap managers, trailed significantly, but for the month, I'll give them the month, they were up over 23.5% in the month, but certainly not enough to take away the longer term underperformance. I want to if you go quickly to page 185, point out a couple things that Vince said, Matthias said, and I referenced as well. Core fixed income for the month up 2.34. The benchmark was at 1.78. Two detractors last for the quarter were the PIMCO portfolio, which was up 4.98 for the month, and PGIM, which is up 3.21. So strong outperformance against their benchmark. Those things that hurt them came back some. their underexposure to treasuries hurt them in the quarter, but helped them for the month. And then non-core, just to point out again, the public market segment of the fixed income pool, that is your unconstrained with Loomis sales and also your Sankman high yield. That and your bank loan portfolio were the worst performers last quarter, and you can see they had at least the public markets had a bit of a bounce back for the month, as did bank loans. So just wanted to point out again, because Vince mentioned it, some of the things that were headwinds actually worked to your favor for the month of April. Madam Chair, that's what we had hoped to cover.
Thank you, Marcia. Questions from committee? Question? All right, with that, we're going to move into our quarterly reports for our private equity programs. And just for clarification for my sake, Steve, so we're not going to hear from all of our programs today on their quarterly. Do we spread those out, or how does that work?
Would you repeat that, please, Commissioner?
So why are we not hearing from everyone for a quarterly report today? We're just hearing from the private equity.
We will hear from the others at another time, and it's just time today to hear from Old National and Mexico Private Equity.
Great. Okay, so I'll turn it over to David.
Thank you, Madam Chair. We have the reports for the national program, which I believe begin on page 270, and the New Mexico program that begin on page 297. We have Mercer with us, and they will go through the reports on the performance for the different programs. So I'll turn it over to Mercer.
Thanks, David. It is difficult giving a Q4 performance report in May with so much that's happened in the last few months. So I'm going to talk about some of the high-level details in Q4, and then also some of the things that we've been seeing or hearing about Q1 to give you a sense of what's going on in the portfolio. As a reminder, the reason why we're presenting Q4 in May is the investment managers get their annual audit done with year-end numbers, and then they have 90 to 120 days to send the documents to investors after year-end. We received most of the documents, so we went forward with performance this month. Overall, Q4 had a sizable gain and was a strong quarter overall for the national program. And I'm on page 273, or page 4 of our national private equity performance report. The one-year net IRR for 2019 was 14%, and you can see the year-over-year numbers of the active funds. The since inception net IRR increased from a 9.4% to a 10.1%, and the multiple increased by 400ths. The 10-year return in the graph below increased to an 11.7% overall as well. Q1 performance is expected to be down, but the full impact of current market conditions will likely not be valued into the Q1 performance. As of today, we have about 40% of the net asset value that's reporting, and the portfolio is down about 3% compared to the year-end numbers. But from conversations that we're having with the fund managers, many companies were actually having a great quarter up to mid-March. And so the full impact on these companies is not even known today. So the fund managers expect that there will be losses in Q1, but also expect the losses in Q2 as more is known about the impact on specific companies. The good news is we look through the portfolio, and there's not large exposures to the COVID-19 impacted areas such as oil and gas, leisure facilities, hotels, resorts, and restaurants. Although there is some exposure in the portfolio, so that will have some impact. But the majority of the portfolios in low-impact industries like technology, healthcare, and more stable consumer sub-industries. Turning to the next page, page 274, one of the themes that we've been discussing in past quarterly reports was the lower level of distributions that we were seeing in the first part of 2019. You can see in Q4, in the graph, the distributions came back strongly and were almost $200 million in Q4. which was great to see with the strong market conditions. With the offsetting contributions and then the gain in the portfolio, there was still a small gain in the net asset value despite the high number of distributions. To give you a sense of what's happened with activity since December 31st, Q1 had about 102 million of contributions and 80 million of distributions, which are strong numbers. And I mean, to put it in context, Q1 2020 had about twice the amount of distributions as Q1 2019. And April also had some distributions of 19 million, as some deals that were closed before mid-March and initially agreed on closed in April and distributed the proceeds. We do expect distributions will drop in Q2 and Q3 because many of the fund managers that we've talked to have pulled the sales processes that their companies were involved in due to the economic conditions. I'm going to skip ahead to page 7, which is the benchmarking. Benchmarking is going to change with the March 31st numbers. We'll have to see how things vary. What's interesting is when you look at 2013 and 2015, we're right above the median in those vintage years. Energy exposure does play a role in this. Energy was pretty weak in Q4, and it's going to be also weak in Q1. And so vintage years that have some energy exposure are going to get impacted. But overall, I think most of the vintage years are above median. And the PME on page 277, which is the public market equivalent benchmark, where we compare on a dollar-weighted basis the private equity's 10-year net IRR to various public equity indices. The difference has been changing. It'll be interesting to see what that is as of March 31st. But then we've seen a market recovery post March 31st. So this difference could be volatile for the next few quarters. And then for the national program, I'll end on page 278. The following slides have more details on each of these components. This is the private equity strategy. We do have an annual commitment range of 300 million to 400 million. We've done one commitment so far in 2020 with 50 million, and then today's 75 million to New Mountain 6 is the second one. All the strategy and geography are within the targets that we have. From a concentration standpoint, only one manager is above 10%, but that manager has had pretty good performance of about 13%. So that's been a strong performing manager. The other thing that we've seen that's been nice when looking at managers, we've been disciplined at picking a small number of managers, having a concentrated portfolio to make it more manageable. And then of the legacy portfolio, where there was a lot of funds and a lot of managers, that number has declined down to 113 million. So these older funds have really been taking advantage of the market conditions that we've had before mid-March and liquidating the portfolio, which was great to see. So with that, I'm happy to answer any questions with the National Private Equity Program.
Thank you, Richard. And I guess I didn't read the agenda correctly the first time. When do we hear the Q1 report then?
Q1 report will probably be in August.
Okay, all right. So questions from committee on the national program. This is Linda Eidson. I notice on page 233 of the RVK report that our private equity program is 181 basis points below our benchmark. And I also noticed that by now most of our legacy funds have been liquidated. So that shouldn't be nearly so much of a drag anymore. Can you tell me, is it a benchmark issue, or why are we lagging on a 5-year basis?
There's a couple of things. The RVK report uses time-weighted returns, which with private equity, you want to look at dollar-weighted returns because the managers have discretion on when they draw capital and when they return capital. And we actually did a training, it's probably about 6 years ago now, where we walked through the differences of time-weighted versus dollar-weighted and actually showed that some of the newer funds could actually have a negative time-weighted return while they have a positive multiple and a positive net IRR in the early stages. So it's always hard to compare dollar-weighted to time-weighted because time-weighted just basically takes the quarterly returns and weights them equally without taking into consideration the dollar. There still is a sizable influence of the legacy portfolio. If you look at page 273 of our report, you'll see even just going back to 2015, about half of the portfolio was still vintage year 2009 and before. Now it's 94%, as most of it has been liquidated. But when you look at historic since inception returns, you still see a pretty sizable influence, and that's why we show those two lines there. So you can see that it's 11.7% overall, but if you take out the 2011 and after, the return actually drops down to a 9.8% 10-year net IRR. So you can see the influence of the legacy portfolio there.
Thank you.
Any other questions? Oh, David, yes.
David, I wanted to add one more comment. The staff, we tend to focus more on kind of peer-to-peer comparisons because there's a lot of moving parts in this number. So we're looking at things like how we compare versus TUCs and also obviously how we compare versus the public markets. We tend to focus on that more because private equity benchmarks, by definition, are not investable. They try to do a certain job, but we find some flaws with them.
Thank you, David. Any other questions before we move on to the next agenda item? Okay, hearing none. David, yes?
Spencer, this is Nick Hayes here. I had a question.
Number 10.
Yeah, and so I think you kind of mentioned it a little bit earlier, but now that we're in this new normal stage of the environment, economic and global, what do we need to be thinking about in terms of doing anything different with our private equity plan moving forward? Like, are there things that you're thinking about doing differently, and especially when I think about some of the more infrastructure types of investments. I think I heard that we're not highly invested in I think oil and gas area, but if you could just comment on what we need to think about doing differently in the environment.
Yeah, so going back to page 278, when you look at our strategy targets, one of the things that we're going to be reviewing over the next month is the annual commitment range of $300 million to $400 million, which is, with the impact on the overall portfolio, is $300 million to $400 million still the appropriate pace to get to the target? Because what we don't want to have happen is you end up becoming over-allocated to private equity and to an extent where you get frozen out of the market and not making commitments in what could be a good time to make commitments. From an overall strategy on the private equity side, we expect to still remain focused on buyout and growth. Those have historically performed well after poor economic conditions because the investment opportunities actually improve in economic downturns, and these managers have done well. We remain focused on manager selection, though. You want to do investments in managers that have experience investing across multiple economic cycles, which is one of the pros with New Mountain that we presented today. They've had very consistent returns going back to the year 2000, and they've been through multiple economic cycles, and you can see that consistency. It's not uncommon for a buyout fund to have one bad fund that may have been impacted by economic conditions, but New Mountain's been very consistent. They might not have the highest returns when risk is being rewarded, but they have consistent returns, which is what we like in this market.
tend to look at things more within the particular private equity space. We have lots of different other areas that try to balance the risk-reward of different asset classes. That's Vince and the management committee and the strategy team that tend to balance how they feel about infrastructure versus energy versus private equity versus fixed income, etc. From the private equity perspective, we tend to have very little infrastructure exposure and not much energy exposure because those areas are covered somewhere else. Also, for instance, distressed debt, which sometimes falls under private equity asset classes, we mostly manage through somewhere else. What we look at in terms of a new normal, I would say we're in a transition period here right now. Transition probably being the nicest way of putting it, since the economy is not doing well. Everybody is waiting for things to open up again and to see what that impact is going to be on both employment and on the economy. So I would say, from a perspective going forward, we're looking at things like the capacity of people, of our managers, to be able to borrow and to take on debt, and see how that compares with what they did before, what they were able to do before. And also, we're looking at, as I think other people on the investment team are, looking at some of the areas that were more harder hit and trying to determine whether there are permanent dislocations or whether they're temporary, like some of the harder hit areas in energy, in travel and transportation. There's arguments for both, and we'll keep an eye on that as we think about our allocations going forward.
Great, I appreciate your comments. Thank you.
Any further questions? So we're going to move on now to 3E. David, would you like Richard to do this one as well?
Yes. Go ahead, Richard.
Great. I'm on page 300, or page 4 of our state program performance report. Just as a reminder, when we presented Q3, there was some large write-downs in value. But the good news is we saw stronger performance in Q4, driven by an increase in the share price of a sizable publicly traded company that's in the portfolio, and also some other good news that I'll share on the next slide. You can see that the rolling 10-year net IRR is nearly flat, slightly higher, 6.8 to 6.6%, as the good news in Q4 was offset by the valuation declines in the earlier quarters that we saw. Venture capital firms react differently to the crisis depending on what stage their companies are in. For early stage companies, these companies typically are not expected to have much revenue or have very little revenue. So managers have been working with these companies to lower the cash burn rate so that they don't have to go back to the market to raise capital this year, and rather focus on next year when hopefully economic conditions are better. But managers we have spoken to are also returning to some of the deals that they may have looked at over the last year and passed on because of valuation reasons. So hopefully, with the increased commitment pace we've had in the state program, this will create a favorable environment for the recent commitments that the SIC made. The more mature companies are expected to be more impacted. They've been operating at cash flow break-even or even a slight profit, and weren't expecting to go back to the market for more money. And now they may have to do so, depending on how deep this goes. And that could create a negative valuation impact, at least in the near term, on the companies. If you go to the next page, page 301, you'll see the performance impact there, the $26 million gain that we saw during the quarter. From a cash flow perspective, too, contributions and distributions were nearly even, 4.6 for contributions, 4.2 for distributions. It was a good quarter for distributions. That $4.2 million basically makes up over 70% of 2019's total distributions. So that was great to see from the program. For Q1 2020, we actually saw pretty strong contributions of $10 million, as we're starting to see the new commitments that have been made draw capital for companies. and distributions were at about 1.8 million. But April was a really strong month for the program. We actually received 18 million of distributions, which was nearly the amount that we saw in the national program as well. It was also 3 times the amount of 2019's total distributions. So really, really strong number. What drove it was we had a healthcare company that was acquired by Blackstone that was completed. The gains actually reflected in the Q4 2019 report, but the cash was received in April, and so that was some good news there. If you look at the next slide, which shows the top 5 gains and losses, we spoke last quarter's report about how a sizable public company can actually increase volatility in the portfolio as it's marked to market each quarter, and we're actually seeing that in the co-investment funds where you had the markdowns in Q3, but now they're in the top 4 of the top 5 are co-investment funds that had exposure to this company. The stock price increased by 64% in Q4. It did decline back down in Q1, but until the company is sold, I mean, you just really get these unrealized valuation adjustments that we'll see in the portfolio. So we do expect it's going to be volatile going forward. And then I was going to skip ahead because of time to slide 14 or page 310 and talk about the economic impact of the program. The good news here, we added 2 companies in Q4, and we mentioned one of these in a past meeting where Anzu 2, which was approved in November, invested in a New Mexico-based company called Nature's Toolbox. And then there was one other company that was invested in from the co-investment fund. If you'll recall, the SIC did a $5 million top-up to the 2017 tranche. And so that one was deployed in the new company as well. So that brings the total New Mexico-based companies to 75. If you look at the next 2 lines, the New Mexico SIC level and then the fund level, I wanted to just spend a second on that, describing what the difference is there. When you look at the SIC level, that's the money that actually came from the SIC's portion of the commitment to a fund. So that number is $269 million was invested in New Mexico companies. The fund level looks at the overall fund. So, for example, with Anzu 2, the SIC committed $10 million to the fund, but that fund ended up raising $190 million of commitments. So the SIC's portion is about 5% of the fund. So when they invested in a New Mexico company, you provide 5% of the capital, but 95% of it is coming from other investors, mostly investors that are out of the state. And so that's why you see at the fund level that number being higher than the SIC level, because the fund managers are actually bringing capital from outside of the state to invest in New Mexico. And then on the next page, for some more economic impacts on page 311, the companies that are in the portfolio across all companies had 1,360 jobs. Of those that are currently held that are unrealized, there's just under 1,000 jobs. And then we also look at job growth. So this considers what was the number of jobs the company had when the fund first invested versus what does it have as of December 31st. And we see a job growth of 595 since inception in the portfolio. You can also see the annualized New Mexico payroll is $99 million, and the annualized expenditures on New Mexico goods and services is about $48 million. And so with that, I'm happy to take any questions on the New Mexico program.
Thank you, Richard. Questions from committee?
Do they rate or do you show any of those on what areas of the state all the investments are?
Member Jennings? Yep.
Sorry, what was that question? I didn't quite catch it.
Do you show what areas of the state all the investments are in? By regions or something?
We don't have it in this report, but I think that's a good idea of something that we could potentially add for the future.
That'd be nice to know. I mean, because legislators will ask those questions a lot.
on to agenda item 4, investment matters. Member Eisen. Very abbreviated report. The investment committee, as I previously said, reviewed the item on the consent agenda with New Mountain and approved that for the consent agenda. We also looked at the voting items under item 4. That's IPI Partners, Linden Investors, 1 William Street, and the parametric contract. And the investment committee unanimously approved for recommendation to the SIC all of those matters. Thank you. Any questions for the investment committee? All right, with that, we're going to move on to agenda item 4B, and this is a vote on the investment for real return IPI Partners 2, and I'll turn it over to Paul.
Thank you, Madam Chair. Just doing a sound check here.
Yep, loud and clear.
Great, thank you. Good morning. I'm Paul Chapman, Director of Real Estate and Real Return, and I'd like to introduce you over the phone to Matt Ahern, who's a partner at IPI, and Tom Lynch, managing partner at Iron Point. Iron Point, along with Iconic, is one of the two partners that constitute IPI. We also have on the phone Jack Koch and Seth Marcus from our consultant Townsend, as well as the rest of the SIC Real Estate Real Return team, Clay Camper and Nino Carpenito. Seth and Townsend recommend a commitment of up to $100 million to the main fund and $25 million of co-investment to IPI Partners 2, a closed-end commingled data center fund. It's a U.S.-centric portfolio, and it'll seek to be current cash flow oriented with long-term, mostly triple net leases and contractual rent bumps. The fund is co-sponsored by Iconic Capital and Iron Point Partners as a 50-50 joint venture. IPI 2 seeks to raise $1.5 billion, targeting a net IRR and net multiple of at least 12% and 1.7% respectively over a 12-year term, using up to 65% leverage. For context, I'll remind the Council that the SIC's real assets portfolio is invested in 4 primary asset types: timber, agriculture, energy, and infrastructure. Our infrastructure portfolio is generally categorized into transportation, utilities, energy, and our energy portfolio consists of renewable power, natural gas-generated power, and midstream assets. And then the last bucket is communications. And in the communications portfolio, we have cell towers, small cell networks, fiber, and data centers. We have existing investments in data centers through existing diversified infrastructure funds, including Brookfield and Macquarie, but the IPI commitment will be the first dedicated to a data center strategy. So what is a data center? A data center is a physical facility that organizations use to house their critical applications and data. A data center's design is based on a network of computing and storage resources that enable the delivery of shared applications and data. Data centers require a carefully controlled environment with levels of security, heat management, and power redundancy in the form of battery backup generators and ideally connectivity to more than one electricity transmission source. The demand for data center assets continues to grow exponentially due to the unprecedented growth of demand to store and process new and existing data, and future data usage will continue to grow with demands from artificial intelligence, virtual reality, the Internet of Things, and self-driving vehicles. Staff has determined that an investment in the fund of $100 million, again, that's $75 million to the main fund and $25 of co-investment, is consistent with the real return investment policy objectives. And with that, I'm going to turn the presentation to Matt Ahern, who will discuss the firm and the fund strategy in the market for data storage. Matt?
Thank you, Paul, and thank you, Madam Chair and the Council, for taking time to speak with us today. Again, it's Matt Ahern, and I'm a partner at IPI Partners. I'm joined by Tom Lynch, managing partner at Iron Point. And as Paul mentioned, Iron Point is one of 2 joint venture partners that created IPI. I'd like to cover 3 major topics on the call today. First, IPI and our history. Second, review of the data center sector and its favorable market dynamics. And then 3, how IPI is uniquely positioned to invest in the sector. Starting out with the background on IPI, as Paul mentioned, IPI was started in 2016 by 2 founding groups, Iron Point Partners and Iconic Capital. The thesis really around IPI at its founding was to create a differentiated and strategic capital partner for the sector. This is driven in large part by the history and experience of the 2 founding groups. On one side, you have Iron Point Partners. Iron Point is a multi-strategy fund that was an early investor in the data center sector approximately 10 years ago. Iron Point has strong and deep experience investing in the sector, which again 10 years ago is a long time for data centers, and that investing and development experience is highly valuable and unique here. The other side of IPI is Iconic Capital. Iconic is a multifamily office with offices around the globe. Founding families of Iconic Capital include some of the largest and most successful CEOs, senior executives, and visionaries within the technology world. The relationships and insight that these groups provide are unique and tangible as we look into the future on drivers for the sector, as well as specifically for new investment opportunities. IPI was created by these 2 groups together, again recognizing the opportunity available and the ability to create a differentiated platform. In addition to those 2 partners to execute on this strategy, we have built a dedicated investment team that consists of 14 professionals and growing that bring with them deep experience in the sector in investing, advising, and operating data centers. Second, in terms of market dynamics, we're seeing a number of positive tailwinds that continue to drive the sector. Paul mentioned some of these, but also at the highest level, we continue to see explosive growth in data creation, storage, and transmission. Whether it's growth in the cloud, streaming video, artificial intelligence, autonomous driving, as mentioned, the data that's being created and transmitted continues to grow exponentially. To illustrate this point, even in a pre-COVID world, you would see examples of every minute of the day, over 4.5 million Google searches were performed, over 188 million emails are sent, and nearly 700,000 hours of video are streamed on Netflix, and all of those are growing. In addition, the importance of data centers specifically continues to grow. Companies are outsourcing more and more of their compute needs to data centers and cloud service providers that use data centers. Really, the data and processing that's happening within these facilities really becomes the most valuable resources for the end users, which is their data. And so outsourcing it to groups and investments like we have are critical. Now, especially as we look at the COVID world as it currently looks, the importance of this is even magnified further. We've seen a paradigm shift on how we are living, working, playing right now. And whether it's work from home applications like Zoom or Microsoft Teams and the growth and importance of those applications, or cloud service providers like AWS, Microsoft Azure, or Google Cloud, or even streaming services like Netflix, Hulu, and Amazon Prime, all of these are experiencing significant uplifts in their usage and data transmission. To illustrate the point, Microsoft CEO, for example, recently said on their earnings call that we've seen 2 years worth of digital transformation in the last 2 months alone. A second important point to all of this is the sector has become very sticky with the customers and the data that they're using and storing in data centers. Because of this, the infrastructure that they're putting in place, again, is becoming critical for their businesses and makes the customer likely to stay for a long period of time. We can see this overall impact, positive impacts that these fundamentals are having on the data center sector by looking at the public data center stocks, with the index up almost 20% year to date and positive trading since the start of really the COVID world. The final point I'd like to cover is IPI's positioning the market and the differentiated approach we're taking. I mentioned briefly the partners that created IPI as a strategic platform. It's a combination of Iron Point's experience and Iconic point level. In addition, our dedicated and focused team brings deep experience and relationships that are helpful in managing our investments as well as driving new deal activity. Combination of these points have helped us create a unique portfolio in Fund 1 as well as a deep pipeline of investment opportunities for Fund 2. With that, I'll pause for any questions or comments that the council may have.
All right, Paul, are you ready to go to questions?
Yeah, absolutely.
This is Peter Frank, and I do have a question, which is it okay?
Yep.
My question is, can you describe how we will access the co-investment portion of this investment, how those decisions will be made?
We'll follow the same model, remember, Frank, as we've done with recent co-investments in both the energy and infrastructure space. We'll set like a maximum co-investment per deal. It'll probably be $10 to $15 million of maximum co-investment. We'll have the ability, it'll be discretionary to the manager, so staff won't be involved in the decision. However, we are going to reserve the right to pass on a transaction because of portfolio considerations. Now, I doubt portfolio considerations in infrastructure, because we have a relatively small amount of it in our portfolio. I doubt that's going to, we would use that as an out, but it's definitely something that we bake into all of our, going forward co-investment strategies.
Okay, so as I understand it, we will not really be underwriting each additional co-investment. That will be at the discretion of the manager, bringing it to us saying, we'd like you to ante up or not.
Yeah, and remember that these are transactions that will be invested in by the main fund. So it'll be the same manager underwriting the same deal on our behalf. We're just going to take a bigger bite than we would have if we'd solely been in the main fund. And then the other thing to note with co-investments is there's typically a fee break, which is one of the things that incentivizes us to place capital this way. So in this case, it'll be no fee, no carry. So that helps us, if the capital gets deployed in co-investments, that helps us lower our overall fee exposure.
No, I agree. I understand. Okay, thank you.
Further questions?
Madam Chair, this is Tim.
Member Eichenberg.
Thank you, Madam Chair. On page 330, Paul, where it talks about sponsorship risk, could you elaborate a little bit more on that for me? Because I've got, I'm looking at the operator plus the investor there on page 337, and I guess I just need more input. Thanks.
Yeah, it's a bit of a, and I think I'll have Townsend weigh in on this, but just to kick it off, it is a bit of an unusual structure, having investment managers form a joint venture, which is now a third manager. So it's an odd structure, but I think we got comfortable with it because we thought from the Iron Point side of things, they brought a great deal of expertise in the data center space. And on the Iconic side of things, they bring amazing connectivity to some of the foremost thought leaders in technology, which, implies data usage and data consumption. So that's how we were able to get comfortable with it. But Townsend, Seth, or Jack, do you want to add to that?
Sure. This is Seth. So Paul explained it pretty well. On 337, we outlined the risks, as you mentioned. So it is uncommon to have sort of two co-sponsors of a fund here through a joint venture. It's not ideal, as we state there. This is a 50-50 joint venture. So two voting members of Iconic, two voting members of Iron Point make up the decisions and the management of the business. So bringing in two different sides, two different sponsors creates a bit of risk there, and we highlight it. We got comfortable with this for a a couple reasons. As Paul mentioned, just generally the expertise that each side brings, but also from looking at it from a downside. So if things were to go awry, how would it be addressed? The JV agreement does allow for a buy-sell provision designed to resolve any situations where the co-managing becomes really inefficient or ineffective. So not ideal if that's triggered, but it is a protection. Additionally, the two members at IPI and two members at Iron Point and two members of Iconic are also named as key people in the terms. So if anyone ceases to devote their time or attention to the fund, the investment period is suspended. And then lastly, we as Townsend and Aon perform some operational due diligence on the individual organizations, and we're comfortable with the interaction between the two and the way they're situated and organized.
Thank you, Madam Chair.
Member Eichenberg, would you like to hear from Mr. Ahern on that question as well, or?
If he would like to elaborate more, that'd be great. I just think that, maybe Mr. Ahern could talk a little bit more about how, what I think that the team is spread rather thin, based on the various commitments, and so maybe he could address that. Thank you, Madam Chair.
Matt Ahern, are you going to?
Yeah, sorry, apologies for that. Yes, thank you for the question, and happy to address it. The team that we have brought in specifically into the IPI platform of 14 and then growing, we feel like is well positioned given the experience that each member brings to the table from an underwriting and sourcing standpoint. At a senior level, we have 3 managing directors that really are helping to lead deal activity and execution, and again, continuing to build on that team. Also, because, as mentioned by Townsend, because of the partnership with Iconic and Iron Point, the resources they bring to bear, especially on the back office that we're able to utilize here, I think give us a very strong foundation for Fund 2 to continue to grow.
Thank you.
Thank you, Madam Chair.
Thank you. Any further questions? All right, I think we're ready for a motion. This is Linda Eidson. First of all, I do want to mention to members of the SIC that most of these questions that are brought up at the SIC are discussed at the investment committee, and I welcome anybody to participate in the investment committee. A number of you have, and I really appreciate it. Okay, based on the recommendations of the Council Investment Committee, Real Estate Advisor Townsend, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to IPI Partners 2, $75 million to the main fund, and a $25 million co-investment. Subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold. I'll second.
All right, we've got a motion and a second for the investment into IPI Partners 2. Terry, would you call the roll?
Certainly. Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Linda Eidson.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
And Nicholas Tejas.
Yes.
We have a unanimous decision.
Great. Thank you so much to the team, and thank you to Matt and Tom for being here with us on the call today to take questions.
Thank you, Madam Chair.
Thank you. Okay, with that, we're going to move to agenda item 4C, and this is a presentation on an investment into Linden Investors, and we're going to start with you, Vince, and you can pass
pass it off to whoever you'd like.
Well, thanks, Madam Chair. Just a quick note on this investment and the next one. These two are born out of the opportunities that are being presented to us now with the dislocation in the markets and some of the turmoil that's happening now. Member Tejas asked a really good question earlier, and I just wanted to tag into that if I could, just very briefly. Most of the changes that you'll see in the portfolio over the cycle are asset allocation weighting changes. So you're seeing that now with these. We're moving more money into the non-core fixed income portfolio. That's where these two investments will go. We'd earlier made a larger allocation to that portfolio, anticipating that credit would be an opportunity in the next dislocation. And here we are in the dislocation, and credit is presenting itself as an opportunity. The broader the smaller portfolios, the asset class portfolios, such as private equity, and those we tend to invest over the cycle and even multi-cycle. So, in particular, private equity, is those fund lives are 10, 12, 13 years typically, which is more than an economic cycle, a typical economic cycle. So what you're seeing here is two investments that are born out of the opportunities that are facing us now, and an increase to the non-core fixed income. So Mikhail Kuznetsov has the details on these along with Axio, and I'll turn it over to Mikhail.
Thank you, Vince. Good morning, Madam Chair. Good morning, Council members. This is Mikhail Kuznetsov, Investment Strategist for the State Investment Council. Joining us on this call are Joe Wong, the Chief CEO and the Chief Investment Officer of Linden Advisors, as well as Jim Delaney, who is the Chief Operating Officer of Linden. Jennifer Wildman from our fixed income consultant, AXA, is on the call as well. New Mexico State Investment Council would like to recommend the commitment of $75 million to Linden Advisors' convertible strategy. Linden allocates capital between three core strategies, and at this juncture of time, about 95% of its exposure is to convertible space. Recent market dislocations, the ones that Vince and Matthias were talking about, they actually have led to a huge surge in convertible bond issuances. And to give you some perspective number-wise, as companies seek to enhance liquidity at these uncertain times, this calendar year, 2020, is on pace for the most issuances in more than 15 years, with over 150 new deals since the beginning of the year throughout April this year. To take advantage of this opportunity, Linden uses either the classic convertible arbitrage strategy, where the manager is trying to capture mispriced equity volatility by taking a directional bet in convertible bonds, or capital structure arbitrage, where Linden takes either a long or short position in convertible bonds that can be either over or underpriced compared to other parts of the issuer's capital structure. Overall, we strongly believe that Linden is very well positioned to take advantage of the current credit market dislocations through the convertible bond strategy. And to sum it all up, we also believe that the risk-return profile as well as diversification component of the convertible strategy will be a great addition to our non-core fixed income portfolio, and specifically the structured credit sub-strategy. And with that, I would like to pass it over to Jennifer. Jennifer?
Thank you, Mikhail. Just before passing it to my team to provide Axia's overview of the manager, I just want to provide some high-level context on why we're bringing Bill Tilden and One William Street, the manager, to follow to the council today. Vince already went through a little bit about why we're making the suggestions today. Specific to the credit markets, we saw the rapid and broad dislocation in March, and the sell-off came first in liquid corporate credit markets, also followed through to structured credit. Much of that move has retraced, and I think you've heard that in the performance reports we've heard today in April and May. But there continues to be an opportunity going forward in the liquid credit space through skilled credit selection and underwriting. We also believe there will be opportunities in rescue finance and distress, but I think you'll see those in the meetings to come. But we prioritize the liquid dislocation as those markets are moving quickly, and the opportunities will be a longer-term investment strategy. With that said, New Mexico is lucky to be in a position to have fresh capital put to work, and so Vince and Mikhail have moved quickly to diligence funds and structure credit and convert, which brings us to the two managers being presented today. To start with Lyndon, in particular, this manager has been operating in the convert space with a flagship fund that dates back to 2004. 15 dates even further back, originating at JP Morgan's convert ARB desk. So this manager's experienced in volatile markets, which is something obviously that we're looking for. In addition to convert ARB, the manager will express credit or catalyst-driven views, and we really like the flexibility of the approach, especially given the current opportunity set. So with that, I'm going to turn it over to my colleague, Kevin Gillespie, who joined the call to provide a summary and covers the space in general.
Hi, everybody. This is Kevin Gillespie joining. As discussed, a quick overview. Lyndon has been officially formed in 2004 by colleagues from the JP Morgan convertible arbitrage desk, and originally started managing capital on behalf of Paloma Partners, but today has grown into an independent firm with approximately $3.5 billion under management. The firm is well staffed with over 30 employees, and just about half of that being investment professionals. And what's key here is we note that several founders are still at the firm in key roles, and other key investment professionals have been there for over a decade. We contextualize Lyndon as a premier player in the convertible markets due to its experience in the space, deep capital markets relationships, and flexible balance sheet. And to rewind a little bit and zoom out on the opportunity set, there has been increased issuance since the global financial crisis, most notably in 2018 and 19, but the shape of the issuance has changed in 2020 as new trends come to the market with issuers that need liquidity as well as routine growth deals that Lyndon was used to pricing. However, in both of these cases, now the terms are much more investor-friendly and provide trading opportunities. A little bit further out, we see a liability management opportunities through corporate actions, which is another area where you think Lyndon is skilled. As also discussed, there are two types of trades for convertible bonds: arbitrage, isolating mispriced valuation inputs, and event-driven, which is often focused on catalysts such as M&A and corporate action and other types of legal analysis. In looking at the space, we try to emphasize repeatable investment process that we trust to work, and that starts with the sourcing process. And here we think Lyndon utilizes capital markets relationships and is familiar with the universe, which is doable since it's much smaller than both high-yield bonds and leveraged loans. And again, an emphasis on time in the space helps solidify that familiarity. We think the research is comprehensive and focusing on quantitative, fundamental, and legal analysis, all meant to address mispricing. And lastly, with capital allocation and decision-making, we trust that CIO Joe Wong is an experienced decision-maker that allows us some autonomy to the PM. Overall, through conversations and many meetings, we find the team to be transparent and collaborative. Turning to the business side, we find that the fees are attractive, with headline management fees being about 1.25%, with breaks for size, of which New Mexico is eligible, bringing management fees to 1%. Incentive fees are 15% above a T-bill hurdle, and liquidity is manageable, with quarterly liquidity with 65 days notice. These concerns about a run on the fund are eased with a fund-level redemption triggering an investor-level gate. So if over 20% of the fund is redeemed, investors must redeem 25% of their investment over time each quarterly. One last fee break to highlight is in light of drawdown and other sort of challenges to the market, New Mexico has been given the opportunity to invest in the fund with the start of year high watermark, meaning that the profits earned until the fund reaches the profit a level that it began the year is net or is not charged incentive fee. To briefly summarize, we like Lyndon for a variety of reasons. First of all, the flexibility and the variety of the strategies and the quantitative, fundamental, and legal analysis that goes into it. Of its peers, we find it to be a stable institutional platform with robust analytics, risk management, and trading capabilities. And culturally, we note that turnover has been remarkably low, which we think speaks to a positive environment. Lastly, most important for the opportunities at hand, we think it's an experienced team with excellent capital market relationships that should prove beneficial in the current supply and market environment. We've noted that while return stream may be more volatile than peers, and AUM and leverage may also be somewhat higher, we think that these factors contribute to Lyndon's ability to generate excess returns above peers over the longer term. With that, I'll pause and hand it over to Lyndon to discuss more.
Thank you, Kevin. This is Jim Delaney, the COO at Lyndon Advisors, and as mentioned, I'm joined by our founding partner and CIO, Joe Wong. That was a great introduction. So I think we should move pretty quickly to portfolio, and if we can keep it interactive, that'd be very helpful. But just some additional highlights is this is obviously a very unique time in for investing in general, but specifically in convertible bonds. Over time, and Lyndon, as mentioned earlier, has been investing since 2003. The fund was launched in 2004. And Joe Wong has been investing for over 20 years in this strategy. The reason that this is a unique time and a great opportunity, and frankly, we are getting a lot of interest from other endowment foundation, is that with the dislocation that we saw in the month of March, there are quite a number of companies, and Joe will go through some in detail, that have come to the convert market for rescue financing. So it's become a place, an opportunity, if you will, for a lot of companies that have to raise cash quickly to come. And effectively what we're doing at Lyndon in many cases is taking advantage of the new issue discount that's out there. We work very, very closely with both the companies and also the bankers when they're putting these deals together. We're often brought over the wall on these deals. And there tends to be pretty good liquidity, so a number of these transactions that we're involved with tend to be fairly riskless transactions from the standpoint of we can help influence the size of issuance, what levels the bonds come at. We get a nice allocation, but we can take the advantage of flipping it in the secondary to some of the long-only buyers and crossover buyers and that kind of thing. So we think this is going to continue for certainly the next couple of years here, and I think Lyndon is kind of well positioned, being really the largest player in this space. The other thing I would mention is just the return profile for Lyndon since 2004 is approximately 9.5%. Kevin mentioned that what we have done is we're passing the high watermark along for the month of June and the month of July on to new investors that are coming in. So right now that's about 8% on the in terms of performance fee that the state would not be paying. And in addition to that, we do have a 1% management fee, and we have a T-bill hurdle. It's 1 month T-bills, and the idea behind that is to essentially pass along risk-free rate. So I think we've tried to do, certainly since inception, is to align ourselves with our investors, and we think that our terms of our fund and also our personal investments does that. So with that, I think maybe I'll turn this over to Joe Wong, and he can talk a little bit about some specifics, and if there's any questions, we're happy to answer.
Okay, great. And thanks, everybody. This is Joe Wong, and thanks for having us here today. At Lyndon, we specialize in we have a few strategies. We have options, credit, and converts. For the time being, we're 95% in converts, as Kevin mentioned a little bit earlier. And we found convertible bonds right now is in the market, which is very interesting because we have a ton of volatilities happening in the market. And for convertible bonds, for most positions we own, we tend to be long bond and short stock to be somewhat neutral. Obviously, we have market risk. That's something not avoidable. For the most part, we're taking very limited amount of equity market beta risk. So in other words, we try to be long convexity over the cycle. When stock price goes down, we can buy shares back. Stock price go up, we can short stock to be neutral and just capitalize on the volatilities. Over cycle, that's proven to be a good strategy because convertible bond is a market where companies selling converts with the volatilities which they don't own. They basically are monetizing something for free. That's why the main reason we can get a convertible bond priced at a cheap level. And in addition to the trading volatilities, I think Kevin and Jim mentioned it earlier, the new issue calendar being very, very robust. And I don't want to talk too much, spending more time on that. But the convertible asset class is really growing, and particularly in U.S. has been growing probably at the fastest pace since early 2000. And we think the trend is definitely it could last at least for the next few years. And lastly, I want to mention that the special sits also was being talked about a little earlier. Companies nowadays they're buying back converts, assets in the convert market. Sometimes they had to, and we have some very large cool companies assets in the convert market at
very attractive levels like Carnival, Carnival Cruise or Norwegian Cruise Line, and the Southwest Airlines, and the Booking.com, the formerly the Priceline.com, and those companies are very large tech companies, but accessing the consumer market because they sort of had to use the market to raise the much needed liquidity. And we also have some much larger companies like $50-60 billion market cap companies like Boston Scientific and BDX, and to raise money in the consumer market as well. So I think the market has really matured over the last few years, and that's why we found that very interesting. And in addition to the new paper coming in, a lot of companies are also looking to use the market dislocation to buy back the paper at a discount, or if a converter trading within the money, they would like to clean up the capital structure. So there are some major buyback transactions we've been doing with the company, almost 1 or 2 transactions every month, which have proven to be quite profitable for us. So with that, we think that opportunity is really good, particularly with a drawdown. As we think that going forward over the next say 3 to 5 years, outlook is quite bright. So it will not be a 2009 type of a downturn. Sorry, I don't know where the background noise came from, but I think that 2008 was a tough year, but 2009, look at Linden's portfolio, we did very well, and so given the poor performance in March, we felt like we should be on our way back, And with that, I'll stop here, and any questions, please feel free to let us know.
Thank you, Mr. Wong, and again, thank you to you and Mr. Delaney for being on the phone today to take council questions. And so with that, I was going to go to questions, Vince, if that's okay. Are you finished with your presentation?
That sounds right.
All right, so just a reminder to folks to mute their phones so we don't have the background noise. Do we have council questions for the Linden folks, or Axia, or...
It's Peter Frank.
Member Frank, yeah.
Yes. I have a question and then a general comment. The question is, I don't understand how the T-bill hurdle rate will work. Are we varying it on a monthly basis, a weekly basis, or as the T-bill rate varies and accumulating a hurdle, or is it as a point in time? So that's my question. The other comment is a general comment, and mainly directed, I think, at Axia. I read these 2 proposals and the Axia write-ups, and I have to admit, even having been in investments for a number of years, more than I want to count, I found them very difficult to understand because there's so much jargon, so many acronyms, so many initializations, and argot. And I think, particularly when you get into more esoteric markets for us, of course, convertible bonds is something we haven't done a lot with. I just found it difficult. I think actually you need to think about that as you write your reports to us in the future. I don't want you to dumb it down and you're not writing an educational piece, but I had to go to the dictionary numerous times and just understand what concepts you were talking about. Anyway, if we can get a response to my question on the T-bill hurdle.
Jennifer, would you like to take that?
I think we can leave that for Linden.
Yes. Yeah. Hi. The T-bill. This is Joe. The T-bill calculation is on a monthly basis, and I think that on each month there's determine what the 1 month T-bill will be. That will be determined. That will be the hurdle rate for that particular month.
So we will accumulate a hurdle over the holding period that we have our funds in the investment. I still don't quite see how that works.
So each month has a T-bill rate, and so basically you compound that over 12 months. That became the T-bill hurdle rate for the year.
Okay, so it'll be accumulated on a
yes,
compounded. All right, I think
that's correct.
All right.
Yes.
Okay.
So the goal really provide risk-free rate. It's just that we're in such an unusual time now, with interest rates, which certainly will change over the next 3 to 5 years. but we've always tried to provide risk-free rate. Prior to having the T-bill hurdle, we did have a LIBOR hurdle, but as LIBOR is going to be going away, we made a change in really just last year to go to T-bills.
Okay, so the answer is, yeah, I understand the mathematics. Of course, the hurdle is quite low because the rate's quite low.
Yeah, that's exactly right. And our expectation is, though, rates are going to normalize. But as I mentioned, obviously, these are unusual times in terms of the interest rates, which, as you guys are aware also, that also it makes obviously more difficult. That area, we feel like certainly in our space, double-digit returns, low double-digit returns are going to be very.
Mr. Delaney, I don't think we heard the last part of your comment there.
Phones are coming in and out.
Yeah. Hey, this is Joe. I think that Jim's phone connection was coming in and out. Yeah, I think what Jim meant to say that with the T-bill rate being so low, and but we had the T-bill LIBOR hurdle over the last few years, and last year and the year before the rates were a lot higher. We expect obviously rates eventually will normalize. Somehow we do have inflation response in the future down the road. The hurdle rate obviously will be a lot higher. And we think that even with the rates at current low level, Linden still will be able to generate some high single digit, potentially double digit returns, particularly given how attractive the market has been.
Thank you, Joe. Listen, I apologize because still in a work from home environment here.
Yes, and this is Jennifer. This is Jennifer from Axia. I just wanted to address the second topic. We're happy to absolutely review the reports and make sure we can sort of convert the jargon and provide any definitions within the reports. So apologies for that. In the future, we'll take care of that.
Yeah, I'm not being critical. I think you just kind of get self-involved. You understand the product really well, and you have to recognize that it's probably for at least a few of us on the council a bit new and very difficult.
Yes, absolutely. Fair comment. Thank you.
Member Frank?
Oh, I'm done. Thank you. Thank you very much.
Do we have further questions on this item? All right, I think we're ready for a motion.
Okay, Madam Chair, this is Linda Eidson. Based on the recommendations of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to Linden Investors LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policy, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold. I'll second.
All right, so we've got a motion and a second on agenda item 4C, the investment into Linden. And so if we could have a roll call on that vote, please, Carrie.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes, sorry, yes.
Linda Eitzen.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Michael Messina.
Yes.
And Nicholas Tejas.
Yes.
Thank you again. It's a unanimous vote.
Thank you, Carrie, and thank you again to the folks from Linden for being on the call with us. Thanks to Axia for putting together that presentation. Next, we're going to move to agenda item 4D, which is a vote on the investment into 1 William Street. And if I could have Vince begin.
Sure, thanks, Madam Chair. Let me just defer right away to Mihail. He and actually have the details for you.
Thank you, Vince. And with us on this call are the AXA team, as well as David Shearer, who is a founder, managing partner, and CIO of 1 William Street Capital, as well as Josh Simons, who is a partner and the head of business development at 1 William Street. New Mexico State Investment Council would like to recommend a $100 million commitment to 1 William Street Credit Opportunity Fund. This manager has been on SIC's radar for quite some time now, and we overall believe that it's a very well-positioned manager to take advantage of the existing opportunity set that has been created by the recent credit market dislocations. A couple of things that we would like to mention. One is 1 William Street manages a very well-diversified portfolio that's focused primarily on asset-based credit opportunities, including but not limited to residential and commercial mortgage-backed securities, commercial and consumer asset-backed securities, and direct lending, just to name a few. The fund is also very well diversified, not only from the investment product perspective, but also from the geographical perspective, with a little less than 1/3 of the portfolio invested in European asset-backed securities, which put them in a great position to take advantage of the credit market dislocations in Europe. And secondly, I would like to also mention that 1 William Street strategy flexibility is great. The Credit Opportunity Fund concentrates about 80% of its portfolio composition in two sub-strategies, which are fundamental credit and event-driven. And we strongly believe that 1 William Street is doing a great job by dynamically allocating between these two sub-strategies. Overall, we think that 1 William Street Credit Opportunities Fund strategy flexibility, depth and breadth of diversification, as well as reliable risk control measures and experience of its team will allow them to make a material contribution to our structured credit sub-strategy, as well as the non-core fixed income portfolio as a whole. With that, I would like to pass it over to AXA. Jennifer?
Yes, I gave an overview before, so I'll be brief on this particular option. So for 1 William Street Credit Opportunities, I just want to note that this is a manager we've had in the pipeline for some time. There were many other opportunities that were prioritized for New Mexico as we were looking to build out for the non-core portfolio into more diversified strategies, as well as direct lending and contingent funds, really to prepare for potential dislocation. But we continue to review 1 William Street with staff and keep an eye on the strategy. And just as the markets have unfolded year to date, we really believe that the opportunity set has increased for structured credit, and in particular, we really like the manager's multi-strategy approach. And for structured credit, we really wanted an experienced team to execute this strategy. So with that, I'm just going to bring Ilya Riskin on the line to present in more detail.
Yeah, sure. Thank you, Jennifer. Some of the things that I was going to mention have already been kind of touched upon by both Mikhail and Jennifer, but I'll just say that, 1 William Street launched kind of in the eye of the financial crisis, a number of years ago. We see David as a steady hand in the structured markets. They bring a ton of experience across the primary and the secondary markets of the trade. Generally, we think they're thoughtful and transparent and again, very open around sort of what the opportunity set is. They've been kind of upfront in saying that at certain times, essentially spreads were unsustainably tight, or there's poor compensation for kind of complexity and leverage, and they've always been very transparent about that. I think, again, to borrow a word here, is flexibility. I think they're intellectually flexible across sectors. I think they are flexible around kind of structural and financial leverage, which one offers a better kind of risk reward at any kind of point in time. Nimble in terms of rotating around across sectors. Nimble across sourcing. I think it was mentioned that there's the ability to source, especially on the CRE side. In Europe, there's the ability to source, in the primary markets, as well as play across the secondary markets again. The managing money versus it's focused on building sort of a larger kind of asset manager by gathering assets. And with respect to the Credit Opportunity Fund in particular, again, it's the longer duration kind of product that is less focused on liquidity, and I think that this is a good time to be invested in the sort of flexible product where the opportunity set may well have two legs to it, or at least two distinct strategies. One being, dislocated tranches, and you kind of solved out of that in March until a lesser degree in April. That seems to have now subsided, at least with respect to more senior tranches. But you're also going to have, a leg of distress, really, as activity in the real economy comes flowing through structured product. And I think you're going to have a lot more kind of noise on the subordinated side. And we think the manager and the product are well positioned to, again, take advantage of both buying up discounted tranches and also affecting, either whole loan purchases, carve-outs, kind of remediation activity with respect to these, to these portfolios. So I think it's the right product, kind of at the right time.
Jennifer, did you want 1 Million Street folks to present at this time, Mr. Scheer and Mr. Simon? Yes, of course. Apologies.
Well, thank you, Madam Chair, and the SIC for the opportunity to present. This is David Scheer. As mentioned, I am the managing partner and CIO of OWS Capital. I'm going to give you a little bit of background on the firm. I'm going to spend a few minutes on kind of the investment landscape, and then I'll speak to how I see the investment opportunity over the intermediate term playing out. In terms of background, OWS Capital, 1 Million Street Capital, is an alternative credit platform with a primary focus on what we think of as asset-based and structured credit opportunities, in contrast to kind of multiple of EBITDA or traditional kind of corporate credit or corporate debt. We tend to focus on things that have some form of intangible or tangible, more importantly, underlying asset coverage that speaks to a lot of real estate related debt in both the residential, in the case of what we call non-agency or non-government guaranteed residential securities, or commercial real estate, what we call commercial mortgage-backed securities or CMBS. We look at a host of consumer receivables, from auto loans and credit cards, unsecured consumer debt, to somewhat more esoteric commercial asset-backed securities, things that might be secured by royalties or franchise fee streams or billboards and cell towers and other annuity-like type cash flow. In designing the mandate of the platform, it was very important to me to strike a balance between being focused on a particular set of assets and or strategies, but not being too small and too niche such that those strategies go out of favor cross-cycle. So our mandate, we think, has specific breadth, not just across the individual asset classes, but as you become more familiar with structured credit, you'll see that within each one of these asset classes, there's different attachment points in terms of the specific debt we're buying. We could be investing up the capital structure in things that might be AAA rated and have more of a core kind of risk profile consistent with core lower returns, or we could be investing down the capital structure in an asset-backed security where we might be viewed as the first loss attachment point, where we're exposed to not just realized losses, but expectations of future performance meaningfully impacting the returns the market expects for that type of risk profile. So it was important to us to create a balance between not just asset classes, but also strategies. And across the platforms that we manage and the funds that we manage, we do everything from long, short, market neutral, relative value type portfolio construction to event-driven and distress mandates when those opportunities opportunities are available to sourcing direct loan exposure in residential and commercial and consumer loans, to, in some cases, doing direct lending in the specialty finance and commercial real estate debt markets. When we think about how do we differentiate our platform from others in the space, I think it was touched on somewhat earlier. First and foremost, we do rigorous underwriting and fundamental analysis in all the investments and asset classes that we allocate to, and that varies from traditional bottoms-up underwriting in the case of commercial real estate, where we're looking at, in some cases, at an individual property that might represent the collateral in a transaction that we're investing in, to doing all the bottoms-up traditional commercial real estate valuation work you would expect, to investing in large pools of consumer loans or residential mortgage loans where you're not really underwriting any individual loan, but you're looking at and using models to underwrite underlying low-level characteristics across the entire portfolio and how they might behave across a wide range of fundamental expectations or macro market expectations. And then what I think we do particularly well, which is underrepresented across most platforms, is we bring kind of a level of underwriting, not just the fundamental risk and deriving kind of a hold to maturity return on every asset, but really drilling down and looking at the assets themselves and what is the market risk and what is the price volatility in every one of these securities that we're investing in relative to a benchmark or relative to each other. And, having a perspective for, yes, I'm getting a higher nominal return, I might be getting a 50% higher nominal return than a benchmark, but am I taking 2 times the underlying market risk by acquiring that asset? Is that an appropriate risk-return reward? And then as we kind of look at these individual assets that we own in the portfolio and their relative expected return relative to unit of market risk, we can kind of aggregate that up top-down at the portfolio level and really figure out and tease out at a portfolio level, how do we optimize return relative to risk, and how do we create the most efficient portfolio return relative to overall levels of market risk through portfolio construction. And combining those two, we think, is really where we identify value and identify opportunities in a way that's somewhat unique across the space. To do that obviously requires resources both on the quantitative side in terms of models and analytics, but also requires resources in terms of surveillance, and also requires a very robust control environment on the non-investment side as we look to diversify a lot of these risks across hundreds of individual securities that we own across these portfolios. And so to speak to that, our firm, we've got over 70 kind of employees. I'd say half are on the non-investment side, and we're managing kind of just under $5 billion of AUM. So we're large enough to be relevant across asset classes. We've got the breadth and the AUM to support the appropriate infrastructure, but we're not so large that we're diluting kind of returns in terms of deploying meaningful amounts of capital. When we think about the kind of landscape, we've gone in just a matter of weeks from what we felt was, for a lot of technical reasons, an environment that in many cases was not rewarding you for taking kind of incremental risk. We had seen massive capital flows over the last 5 or so years from retail, from insurance companies, from others into more and more of these unconstrained mandates, looking to outperform historical ag or core benchmarks, in some cases with limited diligence and with a capital base that did not support the mandate. And so we've seen this reach for yield over the last couple of years really drive things from private credit, where you might argue there's embedded leverage, to things like structured credit, where you have structural leverage, really drive down kind of massive capital flows out of these asset classes from investors with an asset liability mismatch that couldn't sustain the portfolios to traditional late cycle behavior where people were running leverage, and not leverage in terms of the quantity of leverage necessarily, but in terms of running leverage strategies on assets that could not support underlying leverage, meaning they were leveraging up incredibly high risk assets for modest incremental return as opposed to potentially levering up lower risk assets if they were to use financial leverage at all to create an equity duration or the volatility, the risk behind the financial leverage that would have been more appropriate. And so all of that has led to a pretty significant repricing of the asset class. And coming into this year, we had a view that the economy was going to kind of perform in line with kind of low growth kind of consensus expectations, maybe modestly underperform from a macro perspective. And we try to position ourselves where a lot of the late cycle excesses, a lot of the weaker underlying credits, or a lot of the slightly more levered capital structures, or some of the weaker asset-backed security structures themselves, akin to corporate loans that may have weak no covenants or weak covenants. A lot of those assets were going to start to underperform. And what has been viewed over the last few months is a series of idiosyncratic underperformance, one-off names defaulting or one-off names underperforming would start to be perceived, as we saw it, as kind of a lot of idiosyncratic underperformance speaks to systemic underperformance, right? And so we thought the market at the margin was going to start to price in more adverse fundamentals and start to price in lower economic growth, and you start to see this steepening, as we call it, of the credit curve, meaning the lower rated tranches or lower rated bonds would start to underperform the higher rated bonds. Well, what we got was a very different environment, and I'm not speaking to the tragic impact of COVID on so many individual lives and so many families. What we got from the capital markets perspective really was a cardiac arrest, right? The economy kind of blew through any expectations of weak or modest underperformance, and a lot of these lower risk assets that even we have in the portfolio were all of a sudden perceived to be potentially fulcrum or potentially at risk for some form of impairment. And the speed at which this happened just forced massive deleveraging on the part of certain holders, whether by virtue of owning highly levered portfolios that just got stopped out from their counterparties, or deleveraging forced by an asset liability mismatch in the case of retail, where people wanted their money back and investors were forced to sell into a market that really did not have the capacity to take down the amount of assets that were being forced. And so the combination of the speed of the unwind and the magnitude of the asset sales really took assets to unprecedented levels, prices we haven't seen since the depths of the great financial crisis in 2008 and 2009. Now, even with our modest risk profile coming in, we were certainly not spared, and as I said, a lot of the assets that we had in our portfolio certainly underperformed our kind of worst case, in certain cases, expectations of performance. But I would say, given the positioning across the portfolio, given our modest use of financial leverage, and given our ability and focus on underwriting the price volatility of these portfolios, we weren't forced to kind of crystallize losses at the bottom. We weren't forced out of any existing exposures, and we're in a position to kind of recoup the vast majority of the market unrealized losses, which to a large degree we felt were technical, in a position based on the structure of the fund not to have to be concerned with outsized investor redemptions in the near term, to take advantage of what we view as a very compelling pro forma opportunity. And when you think about kind of the opportunity set going forward, you really do have to put it in the context of 2008 and 2009. And we think about it as very bifurcated. You're seeing and you're going to see a continuation of outperformance of the Fed stimulus. You're going to see agency mortgage and obviously Treasury securities repriced to nominal yields that reflect a zero LIBOR environment and the tremendous amount of financial monetary stimulus that the Fed has provided. But you're going to contrast that with trying to kind of underwrite in an environment where there's a lot more uncertainty the impact of the economy on a pro forma basis across consumer, across certain segments within the real estate complex, travel and leisure, hospitality. You're going to see kind of differentiated views on future performance. People don't know what's going to happen with consumer unsecured loans relative to credit card debt. They don't know what's going to happen to student loans. They're not sure how to underwrite hospitality portfolios in an environment where we don't know what's going to happen to growth. We don't know how quickly travel and leisure and business travel are going to come back. So that environment we think speaks very well to the kind of the duration of the opportunity set. It's not a trade. There's not going to be a quick repricing. We think a lot of the investor base that drove pricing over the last 5 or 6 years, REITs, BDCs, overweight retail focused kind of mutual funds, those investors are not coming back anytime soon. And there's a meaningful amount of assets that, while they don't have to be fire sales, you're not going to see forced liquidations. You're going to see assets continue to come out of what is a damaged public and private investor base. And so the opportunity set where you do have kind of uncertainty around future performance speaks to, I think, the value we bring in underwriting. The value we bring to the individual classes and where the best relative value sits, given the uncertainty around the range of performance. So you're going to start to see, there's more and more.
Excuse me, Mr. Scherer?
Yes.
This is Steve Moise. I'm the State Investment Officer. We have quite a few other things we need to cover on our agenda, so if you would, as soon as possible, try to bring this to closure, we would appreciate it.
You got it, I apologize. So, long story short, I think we bring the relevant expertise to underwrite complex assets in an environment where performance expectations are not consensus and there's various opinions on performance. And as I said, we look at the opportunity set very much like 2008, 2009. We think you're getting equity-like returns with a degree of safety that's not necessarily available in the equity market, and that return will be a function of yield and cash flow in addition to meaningful capital appreciation. So with that, I will turn it over to questions.
Thank you, Mr. Scheer, for that analysis of the markets and the conclusion about why this is a good opportunity for the Investment Council at this time. Do I have questions from committee? Hearing none, I'm ready for a motion.
Madam Chair, based on the recommendations of the Council Investment Committee, Fixed Income Advisor AXIA, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $100 million to 1 William Street Credit Opportunity Fund, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold. Second.
All right, we've got a motion and a second on agenda item 4D, the investment in 1 William Street. Carrie, please call the roll, please.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Linda Eitzen.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Michael Messina.
Yes.
And Nicholas Tejas.
Yes.
You have unanimous approval.
Thank you, Carrie, and thank you to our folks on the line for putting together the presentation, our staff, Axia, and thank you to Mr. Shear and Mr. Simons for being present for questions. With that, we're going to go on to agenda item 4E, which is the vote on the parametric contract. I'm going to turn it over to you, Vince.
Thanks, Madam Chair, and thank you very much, council members, for those approvals. Those really help us move forward in those two portions of the portfolio. What you have before you today is a memo that looks a lot like the one you had last month when we asked for or 2 months ago, I guess, when we asked for approval to search for a manager in this space. As you recall, this is a manager that we've worked with before, Parametric, in a strategy or a service that we've used before, and that's essentially derivative overlays or exposure management, directed exposure management, as we call it here. But this will allow us to use the derivatives markets, primarily stock futures and bond futures, to make beta overlays or make overlays to the portfolio to increase and decrease exposures in those two asset classes, publicly traded stocks and primarily in treasury bonds. So there are several uses for this. One is rebalancing. So if we need to take additional stock exposure or we need to take additional bond exposure, we can do that within the derivative markets and then later do it in the cash markets when we can get cash moved. As you know, we can only trade once a month as the pools are unitized, and we develop a unit price and then trade at the beginning of the month, each month in the asset pool. This allows us to trade intra-month by taking the derivative exposure and then moving cash into those markets at the beginning of the following month. So just gives us additional flexibility. We had this service before, as I mentioned. We didn't use it as much as we thought we might, so we discontinued it. This contract that we're bringing you here is much lower cost than we were paying before on the previous contract for reduced service, and so I think it's a better mix for us in terms of how much we'll need to use it and the costs that are associated with it. Again, this just gives us a little additional flexibility when markets are volatile to make asset allocation or asset weighting changes, rebalancing type changes, and it should. I expect it will produce a useful tool for us. So with that, Madam Chair, I'll field any questions that the council has or provide any further explanation.
Thank you. Questions for Vince?
Madam Chair, this is Harold. Go ahead.
I heard two right in a row, so I'm going to go with Member Lavender first.
Okay, thank you, Madam Vice Chair. You know what, most of the council knows my background, and I could actually say what took us so long, but what I'm going to say instead is I think this is a great move, and I think that this adding this flexibility is really critically important to being able to navigate the kind of markets we're sensing now and in the future. So I'm strongly in favor of this one.
Thank you. Who else did I hear wants to speak?
Please.
Member Ralston.
Thank you. Vince, on the memorandum, you've mentioned that the quarterly fee is going to be, but I don't see anywhere where you project some sort of advantage or that an offsetting. Okay, we should be able to increase revenue by X%, or I don't see the positive side of that. And I just wondered if you were able to kind of at least bring that down to an amount that you projected it would increase in return, or besides just flexibility. I know that flexibility is important. I know that being able to work, rather than just one time a year is critical, or one time a month. But I just try to put dollars and cents on the investment.
Sure. Yeah, I get where you're going, Member Ralston. That's really difficult. In fact, it's probably impossible. So a typical action with this would be, let's say the market falls like it did in March, and we wanted to buy stocks and sell bonds, do a rebalancing in that direction. So let's say just for an example, we would Same thing on the downside. So in the short run, you can see you can see losses in this for using this tool. But the main point is to try to get us in the long run closer to our targets, more of the time.
Okay, it's just normally, if we're going to invest $150,000 a year in an asset, just as an asset, it's a tool to help us do better. My business mind, I understand what you're trying to say in terms of functionality, but I'm trying to say, okay, if I'm going 150,000 over here, this is what it's going to produce. It's going to produce more flexibility, more timeliness. It might be positive, it might be negative. I'd just like to see a more definite, this will definitely increase our return besides getting us closer to our benchmarks or our targets. Anyway, thank you.
Okay.
Thank you, Member Austin. Any other questions on this item? I'm ready for a motion.
Madam Chair, based on the recommendations of SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council authorize a contract with Parametric for derivative overlay services as discussed by the Council today, and subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold, second.
Okay, I've got a motion and a second on agenda item 4E, contract with Parametric for derivative overlay contract. If I could have the roll call, please, Carrie?
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Please get on your desk.
Yeah.
Peter Frank.
Yes.
Linda Eitzen.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Michael Messina.
Yes.
And Nicholas Tejas.
Yes.
Again, a unanimous approval. Great, thank you so much, Carrie. If we could move on now to agenda item 5, that is Brent's report.
Madam Vice Chair,
Yes.
This is Harold. I wanted just before we make this move, I think that I'd like to, we sometimes, it's easy to criticize. In this case, I would like to give some serious credit to Vince, his staff, and RVK. I think that at least several of the investments today are proof positive of how important it has been to keep some dry powder available to make these kinds of investments during this time of disruption, dislocation, or whatever one wants to call it. And I think that that kind of policy, as the market continued to go higher and higher and higher, it kind of made you wonder sometimes about that. But there's no question that in this situation, that was a really positive development, being able to make these kinds of investments. I think that, so many people tend to look at getting out. And I think how important it is that we're looking instead at how to get more in an advantageous manner. So I just want to make sure that the council recognizes the fact that those were really positive moves. And I'm really happy that that's how it ended up.
Very good, Member Lavender. I appreciate that. Anyone else? Okay, agenda item 5. Brent, are you ready?
Yes, I am, Madam Chair. And I'll be as brief as I can. Shouldn't take more than 5 to 10 minutes. I'm on page 484 of the diligent materials. Just a couple of things I wanted to point out, if I could. Item number 2 on page 484 relates to the investment holdings report. And I just wanted to point out, relative to March on the April report, the market did rebound. want to emphasize, and I think Richard Puckmeyer said this earlier, the March 31st evaluations for our private investments are not yet reflected. And those will be coming in, still probably a couple of months off. So everybody needs to kind of be aware that we have probably some adjustments that will be coming as it relates to, the market drawdown. And then on item number 4, I just wanted to point out, because we haven't said too much about this earlier, I know there's a special session in June, but we are, for fiscal year 21, working to get the Early Childhood Education and Care Fund set up on SHARE. We've submitted all the documents to DFA to get that done, and hopefully within the next week or so, we'll get that actually transacted. We are expecting, although I'm not sure of the final amount, a transfer in July as it relates to the Early Childhood Education Fund. I think the initial numbers that they were talking about was over $300 million. I think maybe $325 or $320 million. Due to me not knowing what's going to happen at the special session, I'm not sure if that number might change, but I wanted everybody to at least know that we were working on this area. And then if everybody could turn to page 486. Budget summary for the 10 months ending as of April 30th. If you look at the far right-hand column, we do have budget savings. I would expect many of these budget savings to hold up through the end of the fiscal year. We are going through right now and looking at our fees and our encumbrances to make sure that they're going to be adequate to get us through all the year-end invoices. This number might come down a little bit, but I wouldn't expect it to come down, a whole lot. But I just wanted everybody to know that, for the fiscal year ending June 30th, that we are expecting a fairly sizable budget savings. And then on page 526 of the diligent material, these are the notes as it relates to the investment holdings report. And as I sometimes do, I just wanted to point out that first bullet. We still have seen some pretty large amounts coming over from the land office as it relates to the contributions for the year. And this is April, and I just wanted to point out, and I think you, Madam Chair, have pointed this out before, these numbers are lagged a little bit. This information is related to February, so I believe the next contribution that will be coming over for the land office, we will likely see a fairly sizable decrease relative to what it is right now. And then if you could turn over just one other page, and I like to point this out because I think it kind of sums up some of the things that I pointed out earlier. This is a schedule of the beneficiaries for the Land Grant Permanent Fund. You can see the institutions. This is kind of a roll forward from March to April. And if you look at the capital gain loss and the unrealized capital gain loss, you can see if you add those numbers up, you're over $700 million. For the Land Grant Permanent Fund in March, it drew down approximately $1.2 billion. Through the end of April, we've made up a good part of that based upon what's happened in the market. Again, and I think everybody's trying to be cautious relative to earnings coming in. We really don't know what's going to happen in the next 2 to 3 to 4 months as earnings come in. So we're very positive about what happened in April, but we could continue to have some market volatility as earnings come in. And then I did want to point out, because we weren't really expecting this, into the tax stabilization Stabilization Reserve Fund, and Charlie might have additional insight on this. We did get in May a transfer of about $43 million for the oil and gas emergency school tax. I guess there are some thresholds that have to be met, and then once those thresholds are met, those monies above those thresholds come through the Tax Stabilization Reserve Fund. They did, with that transfer, let us know that we might expect through the end of the fiscal year another $32 to $72 million. So we're kind of waiting to see how that plays out. They did say that, this is related to this fiscal year based upon, some of the activity in the oil and gas market. We probably will not see those types of contributions in the future, but who knows? We'll just have to wait and see. And then lastly, I just wanted to let everybody know probably the biggest thing my area is doing is just making sure that as we approach June 30th, which is the end of the fiscal year, that we have everything in order. We're making sure that we're staying up on invoices. We're getting all sorts of directives and memos from DFA to make sure that they're ready, that we're ready for the year-end audit. I don't anticipate any problems with the year-end audit, even though we've been working remotely for some time. I think we're in good shape, and we will continue to work hard on trying to stay up with everything. And that's all I had, Madam Chair, unless there's questions.
Thank you, Brent. And yeah, you are correct that my office takes royalty from our remitters 3 months after the production occurs. So now here, upcoming, we'll start to see the impact of the March declines in WTI, and we were projecting probably about half of the revenue that we had realized the month prior. So probably around something like $80 million into my office.
That's very much in line with what I was expecting.
Yeah. Okay. All right. So questions for Brent? Great. So with that, we are going to move on. We have 2 guest presenters with us today. I hope they're still on the line. Mr. Badal and Mr. Cummins from the SIC.
This is Joe Badal. I am here.
Very good. Thank you so much for being with us.
This is Russ Cummins. I'm here also.
Our page, I believe it's 528, is where your presentation begins, and I will turn it over to you.
Thank you, Madam Chair, and thank you, members of the council. We're pleased to be here this morning. It's been somewhat hectic for the last 60 days or so for the NMSBIC, and we thought we'd give you a taste of what we've been up to, and I'm going to turn it over to Russ Cummins, our Executive Director and Investment Advisor, to walk you through it, and please, if you have any questions, just stop us at any time. So thank you. Russ, you're on.
Thank you, Joe, and Madam Chair and members of the committee. This is Russ Cummins, and so there's page numbers to the presentation that are separate from your board package, and those are what I will refer to. And if you will go to page 2, I'll start there. The Small Business Investment Corporation was formed in 2001. It is a non-profit corporation created by the state of New Mexico. We are funded by an allocation of 2% of the Severance Tax Permanent Fund. Our assets are now at about $96 million, and that allocation increased as part of the 2019 legislative session from 1% to 2%. Our purpose is to make debt and equity investments to create new job opportunities to support new or expanding businesses. On page 3, here's a list of our board members. Joe Badal is on the phone. We also have Alan Fowler. Treasurer Eichenberg is on our board. The state treasurer holds a permanent seat on the board. We have Roxana Myers, Lupe Garcia, and Steve Morgan, and you can see the dates when they came on to the board, and we've had good longevity board members. On page 4, the NMSBIC, it is a virtual company. We don't have an office. We don't have any employees. I'm a contractor. Investments are made in connection with cooperative agreement partners. We refer to them as lending partners. So we don't make any direct loans to small businesses. All the loans are made by our lending partners. And since 2011, our focus has been on expanding our lending program. On page 5, this is a list of the current commitments of our $96 million in assets. Currently, $81 million are committed. Now, I will note that if you look at the second lending partner, DreamSpring, which was formerly Axiom, $30 million of that is for the Small Business Administration Paycheck Protection Program loan program, and we expect those loans to be paid back relatively soon, within the next few months, as the SBA starts purchasing these loans. And the other thing too is, if you look at the first 6 partners on this list, the Loan Fund, DreamSpring West, HomeWise, Lift Fund, and Ventana Fund, those 6 lending partners are community development financial institutions. And if you turn to the next page, page 6, the Community Development Financial Institutions, or CDFIs, they received their designation from the U.S. Treasury. The program was established in 1994 to provide funding to communities and people who lack access to financing, including businesses owned by minorities, women, veterans, and people with disabilities. The CDFIs make loans to small businesses that don't have access to funding from traditional banks. They have a good relationship with the banks around the state. In fact, the CDFI's number one source of loan referrals comes from the banks around the state. Their loan performance has been good due to high-touch personal relationships and technical assistance. The technical assistance, includes things like helping businesses set up a computerized accounting system, helping them set up a website, helping them with things with a marketing plan, things like that. If you turn to page 7, as of June 30, 2019, for the 12 months in that fiscal year, 70% of the loans were made to minority-owned businesses. 38% of the loans made by our lending partners were to women-owned businesses. And since inception, 31 out of 33 New Mexico counties have been served. The CDFI partners, our lending partners, played a critical role during and after the 2008 recession, and they're doing it again, and helping out businesses that have been impacted by the COVID-19 crisis that don't have access to funding from traditional banks. On page 9, this is an overview of our lending program credit risk, and the first point is that for loans made by our lending partners to small businesses, the loans are typically collateralized, and the NMSBIC has a security interest in the loans. In addition, though, and this is a key point, the lending partners are responsible for any loan losses. So we allow the lending partners to make their own underwriting decisions. They get to decide what loans to make, but they are responsible. They're also responsible for any loan losses. And so our credit risk under this program is organizational risk related to the lending partners. We have caps on our lending partner delinquencies, and if they were to exceed these caps, it could require them to repurchase loans out of the program, or it could result in us stopping funding on a go-forward basis. And for the $30 million committed to DreamSpring for the Paycheck Protection Program loans, those loans are guaranteed by the SBA. And at this time, none of our lending partners, we don't think any of them are likely to fail, but we're going to continue to monitor their financial position going forward. On the next page, page 10, I'm not going to read all of this, but I'd like to highlight the fact that these are discussions we're having with potential new lending partners. With RCAC, RCAC would be responsible for any loan losses under the proposed program. Nucinda would be responsible for any loan losses under that proposed loan program. With the New Mexico Economic Development Department, they have a business loan guarantee program, and they've approached us about providing funding if they were to run out of funds for this program. And what we've proposed is there's about $3 million of federal grant funds that
we proposed would be in first loss position, and also if we were going to provide funding on a go-forward basis. Right now they don't charge any fees, and what we proposed is that a fee structure would need to be put in place that would cover more than cover expected losses going forward. At Albuquerque Airport, there's plans for us to provide some construction financing for a 75-acre business park, and part of those discussions would be for the airport to either provide cash collateral or for the city to provide us with a written takeout commitment for when the construction is completed. But the key point here is as we're talking to potential new lending partners, that we are looking for ways to create jobs, but also to reduce the risk to the NMSBIC. The next page, on page 11, these are actions that we've taken as part of the COVID-19 crisis. In March and April, the NMSBIC Board of Directors approved $45 million additional funding to support New Mexico businesses. Now, $30 million of that has been committed to DreamSpring to make SBA Paycheck Protection Program loans. And we expect that $30 million to come back to us within a few months as the SBA begins purchasing those loans from lenders. The second bullet is to support our lending partners' needs related to increased loss allowances, increased operational costs. They could also have some reduced interest margins. The NMSBIC reduced the interest rate it charges lending partners on existing loans from 2% to 1% for 12 months. And then the last thing is we created a COVID-19 lending program where the lending partners receive a discounted interest rate. That when I say discounted, that's at 0% from the NMSBIC to the lending partner. In order for them to get that, the lending partner has to make a loan at 3.75% or less, and that's for up to 36 months. On the next slide, page 12. So on March 31st, the SBA, the Small Business Administration Paycheck Protection Program, and these loans are forgiven if requirements are met. And this is a tremendous program, tremendous benefit to small businesses. However, the challenge identified is that many traditional banks were prioritizing the PPP loans for either existing customers, or they were prioritizing larger businesses with more employees, the logic being that if there were a limited number of loans they could get through the system, that they could help more employees by focusing on larger businesses. But what the result was is that many smaller businesses were having difficulty accessing the PPP loans. And the way the program is structured is financial institutions offering these loans are required to originate with their own funds, and the SBA will start purchasing the loans after about 7 weeks. And so what we did is the NMSBIC provided $30 million in funding to DreamSpring, one of our lending partners and an approved SBA lender. And now we didn't do that right away. We wanted to see their SBA PPP loan application volume. We started this at $5 million, and then it grew to $14 million, and then it went to $21.5 million, and now it's up to $30 million. We think that $30 million is where it will stop. As of May 15th, DreamSpring had 672 PPP loans approved by SBA. They were still in process of funding some of those loans. They had 672 loans approved for a total of $25.6 million and supporting over 3,800 jobs in New Mexico. On the next page, page 13, these next three slides are projecting the impact of these programs on the NMSBIC. On page 13, the blue bars on these slides are the projected existing outstanding loans with existing lending partners. We're projecting those to be about $30 million at the end of this fiscal year and into next fiscal year. And the interest rate on those loans represented by the blue bar have been dropped from 2% to 1% for a period of 12 months. And then if you look at the red bars, this is the COVID-19 lending program, the NMSBIC's program. The interest rate on those loans are at 0% from the NMSBIC, the lending partner, for up to 36 months. And you know, I was talking with Leroy Pacheco, he's president and CEO of the Loan Fund. He commented to me that the NMSBIC's COVID-19 lending program, it's not resulting in a lot of but he thinks it's having a big impact. He said that the SBA's PPP loan is not the right fit for every business, and for many of the loan fund customers, what they've been doing is deferring payments for existing loans for several months, and then providing some extra funding with the COVID-19 program to help pay for expenses like rent and other expenses for a few months. And he said that even though it's not a lot of money, that being able to advance the extra fund has been giving business owners some hope to hang on and the belief that they can make it through this. And he feels that little bit of extra money for this COVID-19 program is having a big impact. And then the last piece, the orange bars on the chart, the PPP loans, you can see those increasing to 30 million, but we expect those funds to come down quickly. We're providing the money to DreamSpring at 0%. DreamSpring gets paid an origination fee from SBA, but then also the interest rate on the loans is 1% to the lender. And so those are expected to go up, but then come back down quickly. If you look at page 14, this is our projected impact on our loan yields. Typically, the loans are provided at 2% to our lending partners. With these programs, we're projecting that our yield will come down to about 0.5% in the last 2 months of this fiscal year, and then in fiscal year 2021, that in the first 8 months, the yield will increase to about 0.9%. And then back up to about 1.8%, and that yield just below 2% could continue for 2 to 3 years because of the COVID-19 program. Those loans can go up to 36 months. On page 15, the top of the chart shows the projected average balances for the different loan programs. And then on the bottom half, you see the projected income or projected loan interest income for this fiscal year with these new programs included. Projected interest income is a little over $431,000 compared to our budget for this year of about $495,000. And then for next fiscal year, we're projecting that loan interest income will be about $390,000. And something that was important to our board chairman and our directors is that the interest income earned on our loans more than covers our overhead expenses. And so you can see here on the bottom row that our management and general expenses are projected to be a little over $281,000 this year and $294,000 for next year. And so based on these projections, even with the reduced yields, we're projecting that the interest income will more than cover our operating expenses. On page 16, equity. So we still have about $3.2 million in equity investments. We're not focused on doing equity investments anymore. At one point, we had up to $33 million committed to equity investments, but starting in 2011, the board changed its focus away from equity investments and towards the lending program. Of that $3.2 million remaining, there could be some companies that are impacted by the COVID-19 crisis, and so we will continue to monitor those equity investments to determine if there's any losses that need to be recorded. Other investment credit risk, our other investments include, we have under a joint powers agreement with State Investment Council, we have an investment in Core Plus Bond Pool. For the month ended March 31, 2020, there is $2.6 million in losses reported on a balance of $49 million. And, this presentation was prepared a week ago, and since then I received the April report. We had about a $1.2 million recovery in the month of April. And I went back and looked at this Core Plus Bond Pool for the 10 months in the current fiscal year, so the 10 months ending April 30th. And for those 10 months, we've earned about $578,000 in interest. We've had $17,000 in management fees, and then a net loss of about $740,000. So the result is a loss, a net loss of only $179,000. I say only; it's still a loss, but that loss is only $179,000 for this fiscal year. And if we look at this, the Core Plus Bond Pool, we've been invested in that since 2016. The performance has been really good over the long term, and I think over the long term it's been a good investment. We also have about $10 million invested in an LGIP account with the State Treasurer's Office. No losses are expected there. And then also we have some funds in checking and money market at a local bank, and those funds are either they're either insured by the FDIC or 100% collateralized with government securities, and no losses are expected. And then on the last page, we're structuring our agreements with lending partners to minimize risk, and we have provided reduced interest rates for a limited time to assist our lending partners and assist New Mexico businesses that have been impacted by the COVID-19 crisis. Our lending partners played a critical role during and after the 2008 recession, and they're doing it again, providing loans to businesses that don't have access to funding from traditional banks. And with funding provided by the NMSBIC, $25.6 million in PPP loans have helped New Mexico businesses retain over 3,800 jobs, and those funds have been inclusive of smaller New Mexico businesses. And so, Madam Chair, that concludes the presentation, and I'd be happy to answer any questions.
Thank you so much, Russ, and thank you to you and Mr. Vidal for being here with us. The 2% that comes out of the Severance Tax Permanent Fund to this program comes up quite often in our council discussions, and so it's good to have the presentation, to have you all here present for questions, but also just to know all of the good work you've been doing during the crisis to help out New Mexico small businesses. I was happy to see those numbers. So I'm going to go now to committee for questions.
Madam Chair,
Linda Eidson.
Terrell.
Holy moly, there's three of you all in a row. Okay, so we'll go with Linda first, and who else is there?
Oh, it's Peter Frank.
Harold.
Okay, all right, so we'll go Linda, Peter, Harold. Member Eidson.
Thank you so much for your excellent presentation. It really helps us understand your program even better and the work that you do. My question is any suggestion that you might have as to how we can carry our amount that we distribute to the SBIC on our materials. It's always been difficult to figure out how to account for it. It's actually right there under investments, and I don't know that that's exactly the right spot. As you know, listening to this presentation all day long, our investments, we expect to get a financial return. And when we do modeling for our asset allocation, we look at the amounts that we have and the expected return from that particular asset class, usually sometimes on our annual return, annual plan, we'll look at it on a 1 to 3 year. On our asset allocation, we're going to look at it on a 7 to 10 year return. So it's always a dilemma when we look at the amount that goes to the SBIC to determine if there is any expected financial return and whether we ought to be carrying it as an investment in our materials. Can you give me some insight into your outlook on whether you believe that there will be any return from the amount that we grant to the SBIC? Thank you.
Yeah, and Member Eidson, this is Russ Cummins. Thank you for the question. First of all, our financial statements, we provide financial statements we do an audit each year. We have audited financial statements that are provided to the State Investment Council, and those have now been put into a Government Accounting Standards Board format, which I believe is consistent with your format. And so I hope that those audited financial statements are helpful for you in recording the SBIC's investments on your balance sheet. Now there is a provision within the legislation referred to as net excess funds, where any funds in excess of our overhead expense are returned to the Severance Tax Permanent Fund each year. And so there was an amount returned to the Severance Tax Permanent Fund in 2016. I believe it was about $2.2 million. But for many years, the investments in the equity funds, the venture capital resulted in losses that's the primary reason why we haven't seen monies being returned to the severance tax permanent fund. And as you may have noted in the presentation, the balance of those investments is down to about $3.2 million. Now there was $33 million originally committed back in the 2005 through 2009. About $33 million committed, and of that, it's between 13 and 14 million was lost, and I think those losses have been the primary reason why you haven't seen monies being returned to the severance tax permanent fund. As those equity funds wind down, I do anticipate that we will get to a point where the loan interest income is more than offsetting our overhead expenses, and I hope to see monies returned to the severance tax permanent fund on a go-forward basis. I don't know if it will happen this fiscal year because we could have additional losses in those equity investments, but I hope to see some regular returns going forward.
Thank you very much. We understand that we are not making, that the SBIC is not a real profit center for us, but it does help us on our modeling. Thank you.
You're welcome.
Thank you, Member Eitzen. And I think next was Member Frank.
Yes, it's just a comment, and I think Russ did a good job of discussing the history just now, which I wanted to mention because most of our council members are now new. The focus on the loan program is terrific, and it was something that we had encouraged, and that's why we were encouraged to change in the board in 2011, and Joe came on and changed the focus and eliminated the losing operation on the equity side. And I'm very pleased with what you're doing. I think it's fantastic. I love the report, and I appreciate your sticking to what you know best, which is the loan program. So thank you.
Thank you, Member Frank.
Thank you, Member Frank. And next we had Member Lavender.
Hi. You know what? I just wanted to, this is actually some kudos. I think Joe and Russ and the state treasurer and their board did an incredible job of making these funds available really quickly. And this was a hugely important 5 or 6 or 7, I don't think, I've lost track of time. But this was really important. And to the small businesses in New Mexico, it's been an incredible lifeline. And I think that the fact that they were able to do what they did as quickly as they did and put the money in the hands of lenders who could actually get it in the hands of those who needed it was really, really terrific. And I'd just like to give you a tip of the hat for the way that you responded to this crisis and putting these funds out. So, way to go.
Thank you, Member Lavender.
Commissioner, this is Steve Moise, if I may, for a moment. Thanks to you, Joe and Russ, for an excellent job in the way you handle these. And I also want to comment on the very fine work that DreamSpring did in getting these loans out. I participated on calls with Ann Haynes and her staff several times, and their commitment to doing this well and doing it quickly was absolutely phenomenal. So thanks to you, SBIC, and thanks to DreamSpring.
Thank you, Steve. Madam Chairman, this is Joe Bedell. If I could make a final comment. We understand at the SBIC that there is a kind of a fundamental conflict is the wrong word, but our orientation is different from the SIC's orientation, and we understand your threshold investment requirements, and we obviously don't meet those requirements. Our missions are different to a great extent, and we're very sensitive about what the SIC needs, and So our position, our board's position has been now for going on 9 years that what we're going to do is do our best to protect the funds that the SIC makes available to the SBIC. And that's why that and the encouragement from the SIC is why we moved away from ill-conceived equity programs and moved to our lending program. And we really appreciate your support. We do understand the differences between our mission and your mission, and we do everything we can to husband the funds that you make available to us. And we thank you for your support that Russ and I have now had for going on 9 years.
Very good. I wouldn't say it's as much of a conflict as maybe inherent tension between the two approaches. But I think that your presentation makes clear today the impact that you all have had on the health of our small business well-being. So I'm very happy to see that. Any further questions from committee members? Treasurer Eichenberg, did you want to weigh in on this one?
Thank you, Madam Chair. I would just echo the remarks that Mr. Moise and Member Franks made, that these two gentlemen have done a wonderful job, and especially the chairman, Mr. Vidal, in changing our direction. That direction was in the process of being changed when I went on the board, and I think we've done a great job in focusing on lending. And I appreciate what Russ does. And he does it without any fanfare and very little publicity. And so it just makes for a great organization to be part of. So thank you, Russ. Thank you, Joe. Thank you, Madam Chair.
Thank you, Mr. Treasurer.
Anyone further from the council? All right, great. Well,
this is Lee. If I could just ask one quick question.
Member Rossett.
Regarding the community development financial institutions and their involvement with the PPP, I'm just curious as to how many of those loans, and maybe they might have been in the right place, the right time, but it seems like most of the people that they lent money to probably has a bank that could have done the same thing. So I'm just trying to figure out what the benefit that they brought versus the bank versus, I kind of heard an implication that the banks might have favored clients that they were focused on.
Yeah, this is Joe Bedell.
Go ahead, Joe.
Having been in banking and associated with the financial services business for almost 4 decades, I got a lot of calls from friends and people referred by friends about trying to get a PPP loan approved at a bank. And the story that I got over and over again was that, and this was in addition, and not just from people that were looking for a bank that they didn't have a relationship with. This was from a number of people that had relationships with some of the larger banks here in New Mexico who couldn't even get a phone call or an email response back. I was able to refer a number of people to Washington Federal as an example, which Michelle Coons, president there, just really pulled out all the stops to try and help people who were not customers of hers at the time. And so I think in some cases the banks failed to support the program. In other cases, banks, as Russ pointed out, focused on their larger clients and did not take care of the smaller clients. So DreamSpring and the other CDFIs that were approved by the Treasury Department to do PPP loans literally were a life preserver for some businesses that had, despite the fact that they had banking relationships, were let down by their banks. And I don't want to sugarcoat it. I think several of the banks really failed to perform for their clients in this instance.
You know,
Russ, did you have something?
This is Tim. And on that, in our bank, in our area, seemed like Wells Fargo was delayed about 4 or 5 days in doing them. And I mean, for our little Pioneer Bank that I'm on the board of, man, it was a blessing for us. We got a lot of new business out of it. It was fantastic, and we didn't care who they were. I mean, it was a good program. You just had to get, when the regulations finally came out, it just took forever to get the regulations straight. But I mean, we did real well with it. We were tickled to death. It was a good deal for us. I mean, if you did it.
Madam Chairman, this is Joe Bedell again. If I might follow up the comment. The community banks in the state, as a class, did a terrific job. It was the larger banks that really did not step up. And so at least that was our observation. And that's why DreamSpring was so important, because a lot of people that did not have a relationship with a small community bank or didn't really know how to go about applying for a loan were helped mightily by organizations like DreamSpring, as well as by banks like Pioneer Bank, Washington Federal, and so forth.
Thank you very much.
Thank you, Member Rawson and Member Jennings. Anyone else? All right, so with that, I'd just like to thank you, gentlemen, for sitting through our meeting today and being available to give us your presentation. I think it was much appreciated by the council members, and good to see the good work you're doing. So thank you all for being here with us.
Thank you, Madam Chairman.
You're welcome. Thank you, Madam Chairman.
Okay, so with that, we're going to move on to closing matters, old or new business. Is there any old or new business before the council today? All right, the next SIC meeting will be on Tuesday, June 23rd, and I believe it's still to be determined how we're going to meet. Steve, is that correct?
Yes, that is correct, Commissioner. We will let you know as soon as we hear.
Okay, so keep your ears out for that, council members. We're going to move to public comment period. Charlie, is there any public comment to be read?
Madam Chair, this is Charles Ruhlman. I have two public comments. One's a little bit longer, but overall it shouldn't take more than 2 minutes. If you want me to go ahead and read those, or alternatively, we could just file them into the record and put them into the minutes. That is your call, Madam Chair.
I think if it takes 2 minutes, let's do it.
Okay. First comment comes from Smith Segura Knoll. His message is to continue making investments with money managers who focus on investments outside of our state, and investments will help rebuild other states, sends a bad message. SIC is not focusing on New Mexico small business investing, is a bad mark on this board. Remember, we are looking at 144,000 people being unemployed. That's Mr. Knoll's comment. The other is slightly longer. It's from Sidney Silver of Santa Fe. The topic is oil and gas. He says, I do not like to take advantage of individuals or companies who are in distress, but there are a lot of oil and gas companies that are simply non-viable due to their debt. For some of them, I have run the bankruptcy models, and they fail to survive under any reasonable assumptions. They overpaid for their land, and creditors will get their assets during the BK process. At $40 oil, which is not an unreasonable expectation for within 3 years or sooner, those assets will be valuable. I think non-New Mexico companies and foreign nations will seek to acquire these assets. The current debt holders in general do not want such assets and cannot handle a 5-year planning horizon. Thus, I think a lot of this may be resolved prior to former bankruptcy proceedings. It is good for New Mexico if those resources are utilized, but who has control Hard Rock Mining, where I was VP of Planning and Financial Analysis for the mining division of Kennecott. But I lived through this with copper, and I know how the process works. I have seen it in action. I know some of the ways that one deals with acquiring distressed assets in a favorable way and in a way that is politically acceptable. Although I'd be willing to help with this, that is not my primary objective. I feel that since I understand the process, it is my duty to suggest that New Mexico considers a strategy in this area, and I have a lot of confidence in the ability of the SIC to play a role in that process. At the end of the comment,
whoever's banging dishes, please mute their phone. Thank you. Okay, so thank you to the public for weighing in with your public comments. Those are weighed by the council members as we make our decisions. I would just request, thank you and request further patience as we work through holding council meetings during this time of crisis, and I apologize that you all are not able to participate live, but we do want to hear from you, and so I encourage folks to watch the YouTube channel where the SIC is aired in real time, and to submit your comments in written form until such time that we are back at least in semi-normalcy. So with that, I'm going to take a motion for adjournment.
So moved.
All right. Member Rawson. Motion by Member Rawson, second by Member Jennings. Rather than a roll call vote, I'll ask if there's any objections to the motion to adjourn. Any objections? All those in favor signify by saying aye. 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 Very good. With that, we are adjourned. Thank you all so much.